When it comes in the face of cocoa prices. Looks like for now it's going to work. That strategy update is something we're going to be keeping an eye on. And of course, miners is a big one. We've been talking about dollar weakness pretty consistently. That is showing up in a little bit of a boost for the commodity names outside of oil. That might show up in the stock move as well, Guy.
Critty, can I just fold something else in as well? If tariffs are incremental, does that favour the luxury sector, which has been hit by that story, that tariff story, over the last few weeks? We'll see how that's priced into the CAC Heron this morning. Is it domestic politics or is it the Trump trade that is going to impact that market? The FTSE 100 is a little light at the get-go. Here we go. We're down by 0.2%, but the IBEX is, as most of Europe is expected to be this morning, up quite nicely. We're up by around 0.6%. The 600's up by around 0.3%. FTSE 100 not going anywhere in a hurry. I'm fascinated to see how the CAC Heron opens this morning. We are watching the politics. We're watching the trade story coming out surrounding this Trump narrative. And as you can see, as we've been highlighting, as Critty and Lizzie have both been flagging, the CAC Heron is up and outperforming this morning by some considerable margin. Why remains the open question. Let's dig into the details and see what is happening there. Critty, what do you got?
Yeah, well, your gut instinct was right because your biggest index contributor to the upside is LVMH, followed by Schneider Electric. So maybe there is that story that you were talking about. It is absolutely the French stocks in the lead, and it's a pretty broad rally across the stock 600. You are seeing it everywhere except for the healthcare sector, and that's a place that I thought was quite interesting because some of your underperformers and index weights, I should say, are the likes of GSK and other healthcare names. Well, Novo Nordisk, of course, a big part of that. But you look at the commodity space, outside of BP and Shell, so your oil and natural gas names, the rest are flying and really rallying, and that's really kind of magnifying the move you've seen in the commodity picture as well.
So you've got the JP Morgan conference, just going back to that issue, the JP Morgan Healthcare Conference taking place in San Francisco. Just be aware of that. We'll talk about that in a few minutes' time. Sorry, Lizzie.
No, I was going to say healthcare also near the bottom of the basket, to your point, down nearly 0.1% there, along with energy, as you say. But the rest of the basket in the green, basic resources at the top, higher, nearly at 0.5%, autos and parts as well. A really positive day here for European equities, but LVMH up 1.6% this morning, so that positivity in France really feeding through there.
Is it positivity in France? This feels like a terror story to me. Has it got anything to do with French politics, or is this to do with the fact that you get incremental tariffs being put on? French luxury, booze, call it what you will, has been hit hard by that in the past, certainly under the last Trump administration. If it's only coming in incrementally, that would favour names like LVMH.
It is, and it's also but just a broad sentiment story. Every single regional index across Europe is higher except for the FTSE 100, and not by a small margin, anywhere from 0.7% to 1%. Of course, to your point, the France is the outperformer, but again, relative to the likes of Italy, of Spain, etc., not by that much of a margin. We are still waiting for the DAX to open, so we'll see which side of the coin they favor.
BP and Shell are both down pretty hard this morning.
Yeah, pretty aggressively.
BP's down by 3%, Shell's down, which has a higher weighting, down by 1.2%.
So the BP story is a delay in their marketing, right? It's a delay, or sorry, in their capital markets day and their revenue weakness. So that was kind of expected, as Joe had highlighted earlier. Shell is the interesting one because Shell has been rallying quite a bit in line with the natural gas story. So I'm curious if that is perhaps a retracement of some of the giant moves we've seen so far.
Absolutely, but that appears to be why London is underperforming today.
Yeah, absolutely.
It appears to be the energy sector rather than anything, again, related back. There seems to be sort of two broad themes happening in the market. There are kind of, well, three maybe, idiosyncratic kind of company stories. You've got the tariff story, which is being folded in as well, plus the domestic politics stories in the UK and in France as well. I just feel like I should just check in and see how gilts have opened as well.
Definitely
just to see what's happened there. Broadly in line, but actually down more. So gilt yields are down by 4.7 basis points this morning, but all of Europe is lower. So the entire complex in Europe is shifting lower in terms of the yields that we're seeing. The US is down by 3.1%, but there's the gilt trade that we're watching so carefully and will continue to do so as we watch Reeves today and inflation tomorrow.
A lot going on. We should mention that the DAX opened up pretty significantly higher, as well, higher by 0.7%. Basically, what you need to know is we've got a rally on our hands in the stock market and the bond market. So what do? We bring on an Uber bear. Sebastian Radler joins the program, head of European equity strategy over at Bank of America Global Research, joining the program. All right, so I knew you were coming on the show, so I've prepared for this. I've prepared for the bearishness, for the doom and gloom. But let's kick it off with the news of the day, this tariff story. We've had this discussion all morning of is the idea, it's still an idea, of a gradual tariff increase of 2 to 5% per month, hypothetically. Is that a dovish move for markets, or is that a positive move for markets in that, a hawkish move for markets in that it, on the one hand, avoids a shock to the system, or on the other hand, could end in 12 months' time with higher tariffs than expected? Yeah. How are you thinking?
Well, the first thing I would say is the range of outcomes is very wide. We're dealing with an administration that's very unorthodox, that is better prepared than they were last time. And the market is basically knowing, on the one hand, growth momentum is very strong, that has kept risk premium extremely tight. And that's something to be very aware of. We've got risk premium in financial markets. They're at the lowest level in 20 years. So not much is priced in. But the market doesn't know now how much of a hit is going to come. It finds it very hard to quantify. And so therefore, the first thing it does, it just shoots from the hip. If there's something that sounds less aggressive than what we've heard before, that is a positive before you see any disconfirmatory evidence.
You, though, are bearish on Europe in absolute terms, but bullish in relative terms.
That sounds complicated.
In the United States, I don't think it's that complicated at all. The relative trade is you're actually fairly positive on Europe. In absolute terms, you're fairly negative on Europe because you think broadly the market is going to go lower. But aren't we getting to the point where, even in absolute terms, you've got a super cheap euro, potentially going even lower. You've got European stocks on kind of historic low valuations. What is the impetus that gets European stocks lower from here?
So I think and I think you're entirely right. It's very important to distinguish between the absolute and the relative story, and they're really worlds apart. In absolute terms, European multiples are roughly in line with the long-run average. The index, the earnings side, an all-time high, margin side, an all-time high, and you've got basically risk premium that are at the lowest level in 20 years, even in Europe. On relative terms, your relative risk premium at a 20-year high, your price relative is at an all-time low, and you've just underperformed by 50%. So what I'm saying is two things. A, we have to see where the good news is priced in and where it's not priced in. And it's this ironic situation where in absolute terms, a lot of good news is priced in because everything is rich across the board, but in relative terms, you've been a tremendous laggard. And the second point is, why are you here in absolute terms? You're here because global growth momentum has been very strong over the last 2 years. We've been surprised quarter after quarter to the upside. And what we're saying is global growth is likely going to slow, and we can discuss why, and there are a number of catalysts, and it's something we haven't seen in 2 years. If global growth slows, risk premium will go wider, assets will go lower. But if you've been the laggard, you can outperform because you've already priced more bad news than the rest.
Okay, so this is the question I keep asking everybody. If the S&P fell by 10%, would Europe fall by 5% or 15%? Your view is that it's more 5%.
That is correct. And it depends, of course, what else happens. There are two conditions under which Europe outperforms. Either a sharp spike in bond yields. Think about 2022, where Europe was an outperformer despite the war starting in Ukraine and despite the energy crisis, which was really flabbergasting at the time. Europe was outperforming by 10% because it's a value trade benefiting from higher bond yields. The second condition is if your relative growth momentum improves. And we see European growth momentum is very weak at the moment. That has scope to rebound, and we can discuss why, even if global growth starts slowing.
What about the particular UK story? Because you've shifted it to market weight despite all of what's gone on in the past week. Do you still stick by that?
Yeah, that's fine, because we need to remember UK is very interesting domestically at the moment with the bond market, but the FTSE 100 is not a trade on the domestic economy. It's effectively a trade on energy. Energy has been underperforming for 2 years. The UK has underperformed in line. It's very cheap now. So unless you've got a strong view on energy or on pound sterling, the UK FTSE 100 trade is not so interesting.
Yeah, so that's the 100, but domestically in the UK,
exactly, that is the interesting story. There you've seen tremendous underperformance, 12% over the last couple of months, as the sentiment has swung. Your price relative to the market is at a 10-year low. And what I'm saying is I'm bearish, but whenever something is cyclical and very cheap and has sold off, I get interested as a contrarian. So we've just shifted domestic UK to an overweight because we're saying you get fiscal stimulus even if it has to be pared down. So likely we'll see an acceleration in growth, but this is now priced for a sharp slowdown. This is one cyclical trade that seems too bearishly priced at the moment. Domestic UK versus the exporters.
I love that you're a contrarian. This is going to be great. So I found a chart from Torsten Slok over at Apollo, and he did a little bit of number crunching and said that the S&P 500 gets 41% of their revenue from Europe and China. So if you are bearish on the European economy and the China economy, basically everything ex-US, there is some sort of kind of reckoning coming for the S&P 500. If you do the same math for the FTSE 100 or the Stock 600, the majority, a bigger majority of that revenue comes from abroad. You just made that point with the FTSE 100. So if you're bullish on the US and you're bullish on the economic resilience, shouldn't just by design of the index, you be bullish on European equities and underweight the S&P 500?
Absolutely. If you're bullish on US growth, which has been driving global growth, then this will continue to compress risk premium and it will basically limit the downside. What we are saying is that, and I should highlight, our US economists expect growth to flatline in the US at current levels, slightly above trend. But we're just saying there's scope for global growth to slow, and partly, and I was just discussing with Guy, partly because we've seen a tremendous amount of dollar strength. And I've sent a chart to your team, not sure whether they've been able to replicate it. Map the dollar strength relative to global macro surprises. It's a very important trading tool. The dollar leads global macro surprises by around 2 months. There is a price to be paid for the dollar strength that we've seen. There's a very high likelihood that global growth will surprise to the downside over the coming months. If that is the case, typically risk premium go wider, asset prices go lower.
Price to be paid by who?
By the markets.
Right.
So
which markets?
Broad risk asset markets globally that have benefited from the fact that for the last 2 years, global macro data has consistently surprised to the upside. If you now get surprises to the downside, as typically happens after bouts of dollar strength, then that is negative for all asset prices.
Does that outweigh euro parity as an option, as a benefit, translated earnings for European equities?
The most important driver of asset prices is global growth momentum, but if you have a cheap currency, you can outperform, hence our call for Europe to...
There's your chart, by the way.
Yes, we did bring it up, and we've got it to show up, to support what you were kind of saying.
Maybe explaining it to the audience. Why does the dollar, it's inverted on the left-hand side. We've seen the strongest bout of dollar strength in 4 years. There's a 2-month lead in there, which I'm not sure is visible on the chart. Macro surprises are very likely going to be more negative than we've seen over recent months because there's a price to be paid if you strengthen the dollar a lot.
But the argument that you're making here is basically that it's, and tell me if I'm watering this down too much, that it's basically too cheap not to own, right? Like that's the argument you're making. At some point we'll get there, that there will be a point, in a line in the sand where things are too cheap not to own, and we're not there yet.
Exactly. But what I'm saying is, you have to distinguish, and Guy made the point at the beginning, between the absolute cost. Europe is very expensive. The risk premium that you have, the valuations relative to rates, is the most expensive in 20 years. Very hard for me to say, I want to be overweight equities relative to rates. On a relative basis, Europe versus the rest of the world, you're the cheapest you've been in 20 years.
Yeah.
When it's cheap, I'm interested. When it's expensive, I'm not. And I think that's really what it's...
But you're basing that more on the rates picture than the rest of the world picture. So if you're an equity allocator, you're basically looking at it from a macro allocation standpoint. But if you're a sole equity allocator, you do want to be bullish on Europe.
I want to be bullish on Europe relative, and I like how you're trying to...
I'm going to get you one day.
A little bit of bullish. You will. What I'm saying is if global growth slows, if macro data surprises to the downside, it's negative for risk asset prices, especially if no risk is priced. Risk premium at a 20-year low. A little bit goes wrong on the macro front, you have to price a higher risk premium. That's not good news for asset prices.
Sebastian, always a pleasure.
Thank you.
Thank you very much indeed. Very well prepared. Everybody's very well prepared. Sebastian Redler, Head of European Equity Strategy, Bank of America Global Research. Core 6 looks like this morning. LVMH is having a good day. The luxury sector certainly is positive, as is everything else, as you can see. Green across the board. What else you got, Joe? Let's find out what's going on with the wider markets.
So we have got some big moves in UK retail today, Guy. JD Sports absolutely slammed at the moment, down another 11%. This stock trading at the lowest level since 2020 now. The company warning of a decline in sales across November and December, not just in the UK, but also in the US as well, where they've done a lot of M&A trying to expand into that market. So as I say, that stock now at a 4-year low, yet another profit warning from JD Sports today. Then going the other way, we've got Ocado, the best performer in Europe today. Now, this is all driven by their retail business, their joint venture with Marks and Spencer's, which they say had their best ever Christmas, and that is countering a big slowdown in some of their robotic warehouse sales, according to the statement today. That stock rallying 12% in the retail space, as I say, best performer in Europe today. Then, in terms of your oil majors, we have that update from BP warning of a slowdown in quarterly production. Now, that was partly expected by the market, but we are seeing a little bit of a feed through into some of the other stocks there. Shell, Total Energies, all declining. Bear in mind, those shares did rise yesterday as we saw a two-day jump in the oil price, but that having an impact on the oil majors in the European market. BP delaying a strategy update as well. Then in terms of chocolate, we've got Lindt. Now, this is all about margins. According to analysts today, they were expecting a bit of a slowdown in the margin growth, given that massive jump that we've seen in cocoa prices over the past year. But that has not come to fruition, and Lindt actually beating forecasts on both earnings and margins. In your ratings, from chocolate to booze, a couple of our favourite subjects. We have got Remy downgraded to underperformer over at Bank of America. A little bit of a decline on that one. And Nexi got a downgrade, and that was one of the worst performers in the payment processing space. That one was slipping after Morgan Stanley goes underweight, down 2.8% in Italy this morning.
All right, Joe Easton from our equities team, we thank you. With our stocks moving at the open. Coming up on the programme, we're going to switch focus to healthcare. M&A very much in the spotlight as leaders meet at the JP Morgan conference over in San Francisco. We'll bring you all the highlights next. This is Bloomberg.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Obviously, there's a lot of commentary on what the new administration's approach to vaccination will be. I think we should wait and see what the facts are when they come through. But any conversation about the efficacy of vaccines, the quality of vaccines, these are things my company is deeply committed to and we want to engage on with transparency.
Very animated GSK CEO, El Walmsley, speaking to Bloomberg from the JP Morgan Healthcare Conference, which is currently taking place in San Francisco, started yesterday, keeps going for the next few days. Sam Fazeli, senior pharmaceutical analyst at Bloomberg Intelligence, still here in London, enjoying the weather here, not there. Let's talk about GSK first of all. She's quite animated, but that doesn't feel like it's being reflected in the share price right now. What is it? Is GSK emblematic of the wider healthcare sector at the moment? Is it idiosyncratic in terms of the problems it faces or the opportunities that it's potentially got on the horizon? What would you say about the potential for Emma Walmsley to outperform here?
Well, she certainly has the energy, Guy. I mean, yes. That's really nice and it's kind of infectious. And you've had her on the scene here, right? Yeah. So, look, the thing is that you have to take what CEOs, of course, she's not going to sit there and say, oh, God, things are terrible. No. You know, at the end of the day, they still have a business to drive and a growth to deliver. And one of the issues that they've faced is that they had a product, the RSV vaccine for respiratory syncytial virus. Maybe that's what I had, right? It got off to an amazingly strong start, and then it started petering out when the reality became an issue, just like the COVID vaccines, just like many of these situations where you rely on people's actions to go and take a shot and government regulations to set it up. It's not like cancer where you got cancer, you get treated if you have access. So that's what happened to that vaccine. The forecast for that vaccine consensus has fallen. Is it a 2-year shot? Is it a 3-year shot? Which group of people should take it? And there's been a lot of pressure on that. That's why the stock has really taken a hammering in the past 6 to 9 months.
What else is on the agenda for this conference? And I say this in the context of a regulatory environment that's about to get a lot easier for M&A and for acquisitions. We know the biotech companies love to do that. How much appetite is there right now in the sector for that?
Oh, there's massive appetite. I mean, there's $200 to $300 billion worth of drug sales, depending on how you measure it, how far you go out, that are going to come off patent. Yeah. So we have a situation again where pharma companies need access to assets. And we've had 3 deals announced yesterday. Unfortunately, it doesn't help the biotech sector because 2 of them were from private companies. What really drives the biotech sector is if the $3, $4, $5 billion companies get taken out. The public deal we had was Johnson & Johnson, which we believe was an excellent match for what they're doing, and perhaps some questions about competition coming up. Yeah. That's to your point, with regards to they have some assets, they acquired a similar asset, what's going to happen? And that was a product in market. So there seems to be a bit of a disconnect where biotech investors are invested, the pharma companies aren't coming yet.
So that's deal making, of course, the Biden administration kind of anti-deal making there. But broadly, what's been the mood music on the incoming Trump administration at the conference in San Francisco? You know, Robert F. Kennedy, famously accusing the drug companies of corruption, talk about mass poisoning, critical of vaccines. Are they still managing to be optimistic over in San Francisco?
They are. If you listen to various people, and pretty much every single individual CEO presenting was asked this question. In soft ways, in hard ways, or RFK Jr., is he bad for the sector? The reality is that they all have to work with this administration. And if he's confirmed, they have to work with him, right? So they can't really take a tough stance here. The reality is some of the things that RFK Jr. has said make sense. Many of the things he has said, you really make no sense at all. Take vaccines. Vaccines are one of the best things that humanity ever invented for itself in terms of healthcare and protection, right? So that's where I think a lot of these folks are trying to get grips with the reality that they've got and manage it.
Everything seems to be an AI trade these days. Is that also the conversation in San Francisco? How much AI is involved in this process now? Which science should we most be excited about? We've also got computing power coming up really rapidly. The ability to understand what is happening at an atomic level is increasing dramatically. How quickly will that impact? Are we getting a flavor from that in San Francisco?
Yes. So both NVIDIA and Dassault Systèmes presented yesterday. And NVIDIA, of course, did its usual thing saying we have a solution for everything. Yep. Right? And they probably do. I mean, I don't cover NVIDIA. One of my colleagues does, and we know where the share market cap is. So that's reflected there. They have a product, a technology, the systems that allow you to do AI, and it's rapidly evolving. Digital twins, robotics, the physical AI, if you want to call it that, agentic AI, all of that's happening. And it's getting deployed in pharma. It's just that pharma companies are, in my view, a little bit like oil tankers. It does take a while to shift it, right? The easy applications are happening now. You know, I'm looking forward to having a podcast with our head of R&D at GSK next week, where we will talk about this. I think they're highly focused on the application of AI and the machine learning to data management for a start, right? These companies are generating data at the speed of light, right? That needs to be managed and understood. There's no question. It's just the timing of how deep it will go will depend on how fast the companies can move.
Sam Fazeli, Senior Pharmaceutical Analyst over at Bloomberg Intelligence, walking us through, of course, the key points and conversations happening in San Francisco around the JP Morgan Healthcare Conference there. I want to talk to another top story happening in California, 6 hours south of San Francisco in L.A. Southern California broadly facing another round of dangerous fire weather as crews struggle to contain wind-driven blazes that have paralyzed Los Angeles for nearly a week and killed at least 24 people. Now, the disaster is expected to be among the costliest in U.S. history, with estimated damages and losses between, get this, $250 to $275 billion. Insurance industry losses alone now estimated at $30 billion. Joining us for more is Bloomberg Intelligence European insurance analyst Charles Graham. Charles, these numbers just keep getting higher and higher. How dangerous is this for the people and for the insurance companies that have pulled out on covering this area?
Well, I think the first thing to say is obviously this is still an ongoing disaster. We have a red warning in place from the Weather Service, the threat of an increase in high winds, and the risk is that more areas of Los Angeles could yet be under threat. And I'm sure this must be an extremely worrying time for the people of the city. Obviously, you know, as this has developed over the last, well, only really the last week, I mean, we've seen initial estimates of around $10 billion for the insured loss, then rise to 20. Now we're talking about 30 billion. And I think it also stands out that that's a very small fraction of the total economic loss, because insurance availability was a big issue for this market.
But Charles, this was a known risk, right? Is this a wake-up call, for want of a better phrase, for these communities in vulnerable areas in an era of climate change?
I think it is. These were some of the areas that were most exposed to wildfire risk of anywhere in the United States, because of the combination of population density, property values, and proximity to bush. And as a result of that, a number of major insurance groups within the US decided that these risks just weren't insurable. And you know, it was also an area where it was difficult for those companies to, in some cases, get reinsurance protection. And what we've seen now is that, you know, as the losses have climbed, we've gone from a position where the expectation was the loss would be taken primarily by all the domestic insurers, to a position where once we get above sort of 20 billion of loss and heading towards 30, then that begins to go into their reinsurance programs.
Okay. Charles Graham of Bloomberg Intelligence, those costs climbing and sadly the human toll as well. Plenty more coming up on the programme. This is Bloomberg.
You missed it on Bloomberg, the China show. What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Very important, the Chancellor, having set out some fiscal targets, having said that she's going to take the public finances seriously, which is very important, that she doesn't erode that credibility.
The markets are not trusting at the moment the new government's commitment to their own fiscal rules.
A change to the fiscal rules might be one thing that could trigger a Liz Truss episode.
And you could be in this never-ending silly merry-go-round because of a move in global bond yields. More sensibly, there isn't any pressure on her to do anything about the markets or her own rules till at least March, when the OBR will come out with their updated forecasts.
And fundamentally, this is an international problem, partly caused by the Trump administration and uncertainty, and we shouldn't panic.
Should we panic? Is the UK market turmoil a UK story, an international story? It's been a debate among our recent guests on Bloomberg TV and radio, reacting to the storm that's rocked our yields and the pound as well. Rachel Reeves very much in the spotlight, her economic agenda at risk. She's speaking in Parliament later. And we can speak now to a man who advised a previous UK Chancellor in a time of austerity. That seems to be what the market's calling for. Rupert Harrison, former Chief of Staff to UK Conservative Chancellor George Osborne and Chair of the UK's Council of Economic Advisers from 2010 to 2015. Good to have you with us, Rupert. If you were advising Rachel Reeves at this point, I wonder how much further you'd have to see yields rising or the pound falling for you to tell her you need to do a bit more, say a bit more, than that you're wedded to your fiscal rules.
Well, there'll be a bit of a sigh of relief in the Treasury this morning. This is the first, certainly as of this morning, the first down day in gilt yields and the first small uptick back in sterling that we've had for at least a week now. But, of course, they're not out of the danger zone. We've got UK inflation data tomorrow, which I think will be a key driver of gilt yields. And markets very nervously watching, particularly the services inflation. I think that Rachel Reeves will, for now, be getting advice from the Treasury that I think don't panic is correct. This is not an immediate market crisis. I think there are things that could turn it into an immediate market crisis. Any sense that she was getting ready to abandon her fiscal rules and that she wasn't taking any signal from the markets, I think that would be concerning. But what they will be doing is very nervously waiting and watching what happens to gilt yields during February, because that is the period during which the Office for Budget Responsibility will take their average, on which they will then base the forecast they're going to publish at the end of March. And from a sort of political point of view, that forecast is the key for Rachel Reeves, because if she is shown in that forecast to be missing her fiscal rules, then she's going to have to come back just 5 months after her budget, and she's going to have to tweak her spending plans, and that's going to be politically extremely embarrassing, and also a very tough sell within the Labour Party.
Yeah, indeed. She's already signalled to us that if the OBR deems her to have run out of headroom, she would pick spending cuts over tax rises. But I wonder, Rupert, if you share some economists' worry that spending cuts, any spending cuts she announces, would lack credibility with markets.
Well, I think that there is a serious risk of that, and I think particularly the most likely option is that she will trim her spending envelope in the last few years of the forecast, and this is something that markets are now very used to UK governments doing. It would be probably outside of the 3-year window of the spending review that she's probably going to set, and therefore it's just a stroke of a pen. It's just changing some numbers on a page. It's not real action. It's not very credible. It might be enough to get her out of a political fix, but it will leave a lingering sense of where's the action? Do they have credibility? There are things she could do up front to earn more credibility. She could bring forward some of the welfare reforms and some of the planned savings to, for example, the rising sickness benefits bill, to make savings in years 1 and 2 and demonstrate action. But I think that is going to be both difficult to implement and also politically difficult for her. So yes, I think the most likely option will be lacking in credibility, but it might be enough to, get her through to the autumn when she can give a more comprehensive budget.
Can she afford to wait until then? Rupert, good morning, it's Guy. There is a worry that if she takes any kind of action, near-term action, that it in some ways would confirm that there is a crisis. How long can she really wait? Can she afford to wait that long?
No, I don't think that is going to feed a sort of spiral of crisis. I think that markets would take some security from signs that she was acting early to get on top of her spending envelope, that she understood the problem. Effectively, she's got a political problem. There's also an economic problem, which is the government's borrowing is crowding out the private sector. It's pushing up borrowing costs for households, for businesses, because markets are finding the government borrowing so hard to digest. So she's actually in a situation where if she could get control of spending in the short term, that might actually provide a boost to the economy. Now, I think that that's unlikely. I think she probably can wait to the autumn unless we get into a significantly worse market situation. And, the inflation data will be important. Recent global moves have been driven by expectations around the Fed and particularly Trump policy. I think we should also not ignore the actions the Biden administration has taken in terms of clamping down on sanctions on shipping of Russian oil that has pushed up oil prices. And that has also been a driver of these rises in gilt yields. So all of these things could get worse between now and the autumn, or they could improve. And she's going to be very vulnerable to those market moves.
Can and should the Bank of England help at this juncture? The bank is still selling gilts into the markets. Given the fact that some of this crisis appears to be imported from elsewhere, you mentioned what is happening in America, US 10 years heading towards 5%. Should the Bank of England maybe tactically think about ways that it can alleviate the situation?
So I think the Bank of England could and should separate its QT bond selling operations from monetary policy, and I think that is still the right frame. If they're concerned about the impact on the economy and their ability to hit the inflation target, they can just cut rates, and that would bring down yields right across the curve. I think that they will be very careful not to get involved in the long end of the gilt yield. They will view that of the gilt curve. They will rightly view that as the government's problem. And a bit like we saw during the trust episode, the Bank of England will say, this is your problem, you fix it. We are rightly focused on hitting our inflation target, managing our balance sheet. Those things should not be driven by government fiscal policy. Then you get into fiscal dominance, and that leads to all sorts of pain in terms of rising term premia and is less good for the economy in the long term. So it's very important that the Bank of England is not seen to be riding to the rescue of the government. This is very much something that is squarely on Rachel Reeves's agenda and not on the governor's agenda.
Rupert, it's Creedy in London as well. you keep talking about the weakness that we saw in the markets, of course, concentrated in the last week. But I would argue that we've been sounding the alarm on the UK's finances for at least the last year, if not longer. Is there a line in the sand for sterling or for the gilt market, or even arguably the FTSE 100 if you want to go that far, that really signals or prompts some sort of emergency measures or a more dire, more bigger response from the government, from the Bank of England, or anyone else at play? Is there a line in the sand you're watching?
Well, I think we're some way away from that, but you are absolutely right that this is something at least of the last 2 or 3 years. I mean, in fact, if you look at the long end of the UK curve, really ever since the Trump mini-budget crisis, the UK 30-year yields have been above US 30-year yields, and they have not come back down below. And I think that we have seen a kind of break in demand for long-dated UK government debt. And fundamentally, you've got a defined benefit pension system and an LDI system that is smaller than it used to be. There is not that kind of deep pool of demand for UK government debt that there was a few years ago and that we got used to for several decades. And I think that speaks to the fact that the UK government is just going to have to work harder to demonstrate fiscal responsibility. It's going to have to pay a higher price to get its debt away. And that's just the environment we're living in. In terms of that kind of trigger point you're talking about, I think that is expressed in rates of change rather than levels. So again, if we get into a sort of doom loop spiral where yields are rising idiosyncratically in the UK, that is forcing selling from actors in the market, and that is driving down the currency. The kind of dynamics we've seen in the Truss episode, that's the kind of environment where you need emergency action. Now, we're a long way away from that. I'm not saying it can't happen, but that's not the market environment we're in at the moment. At the moment, this is a medium-term signal to the government that the price of this extra borrowing is going to be high, and you need to factor that into your plans.
As you say, though, 7 a.m. tomorrow morning, we get inflation data. The market's going to be watching that very carefully. Rupert, great to catch up. Thank you very much indeed for your time this morning. Rupert Harrison, former chair of the UK's Council of Economic Advisors. We greatly appreciate it. Find out a little bit more about how the UK bond markets could be impacting personal finances. There's a live Q&A on Bloomberg.com that is taking place today at 12 p.m. London time. Bloomberg reporters are going to be breaking down the implications for UK mortgage rates. Take a look at what is happening in swaps at the moment, what's happening in savings, what's happening in the equity market. All of this is going to be covered. Terminal clients and digital subscribers can log on and put questions directly to the team, Chrissy.
This is certainly something we're going to be watching very, very closely. In the meantime, let's get to some of our other top stories. Chinese officials are said to be discussing the sale of TikTok's U.S. operations to Elon Musk. We're going to dive into the details next. Stick with us. This is Bloomberg.
First time, got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, and LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to the opening trade. We're about 44 minutes into today's session. Seeing green on the screen everywhere across Europe except for the FTSE 100. That is the underperformer. We'll see, of course, if that changes as we get maybe a little bit more policy direction throughout the rest of the day. But at the moment, it feels like policy is in the driver's seat for all of Europe, specifically in the European Union, where the top digital official has said that the repeated cutting of undersea cables in the Baltic Sea cannot be fully accidental. Henna Verkunen says the bloc needs to be ready for a range of hybrid threats. She also told our very own Oliver Crook that the EU is looking forward to working with the new U.S. president. Take a listen.
Of course, the USA is the most important ally for European Union when it comes to security and also for the economical side. So also at the same time, our sovereignty of our member states, of course, has to be respected. But USA is a very important ally for European Union as well for Denmark. So we are very much looking forward to cooperation with the Trump administration.
One of the things that we've seen a lot of over the last few weeks and months has been damage to undersea cables. I'd like to get an update from you on kind of what we actually know about what has occurred. Or can you establish definitively that this has been sabotage? Do you know who is responsible for it? I know this is going to be a focus for you this week at the Baltic Summit.
Yeah, when it comes to these incidents in Baltic Sea, the Finnish authorities, they are currently investigating this, and they have been working very efficiently. But we will gather together with 8 Baltic Sea countries and with NATO and EU on Tuesday on Helsinki to discuss about these topics, that how we can better prevent and detect and also respond to that kind of incidents. And of course, it can't be really by accident if these are happening many times a year, that oil tanker is navigating anchor on the bottom of the sea and digging the critical infrastructure up.
Yeah, and I think that I wonder if what you think about this. I mean, because of the war in the Ukraine, the horrors that we've seen in Ukraine, and also, you know, in the Middle East, I think there's a bit of a distract. We've been a bit desensitized. If this was happening when there wasn't war around, I think Europe would be much more concerned. Do you think we're already basically in Europe in hybrid warfare with Russia?
It's for sure that we have to be prepared for very different kind of things and different hybrid threats. We have seen that nowadays everything can be weaponized, like migrants. We have been seeing weaponization of migration on our external borders. We have been seeing foreign interference to elections and also damages and sabotage of the critical infrastructure. So it's for sure that Europe has to be better prepared also in the future.
Henna Verkunen, the European Commission Executive Vice President for Tech Sovereignty there, speaking to our very own Oliver Crook. Ollie joins us now. Ollie, she said that last line, that everything can be weaponized, from elections to migrants. What else does she have to say about the defense front?
Yeah, so listen, Kriti, I mean, this is going to be one of the main focuses going into this new commission. You know, these people are going to be around for the next 5 years and sort of appraising kind of the landscape as it stands, what the biggest sort of issues that Europe are facing. That threat of hybrid warfare is certainly going to be very top of the agenda, particularly for her. I mean, the undersea cables is just one side of it, and we were mentioning the Baltic Summit. This is where leaders from the Baltic countries around the sea there are going to be meeting in Helsinki today. You know, Rutte will be there, the head of NATO, but so will Olaf Scholz, to sort of discuss how they can deal with this. How can they deploy more ships to sort of be patrolling what's going on in the Baltic Sea, because these are sort of major infractions that, again, if we were not sort of more sort of inundated with war across the world, would be very, very shocking to Europeans. This had to be a top priority. But it's not just undersea cables. There's also the question of migration. She comes from Finland. Finland is that huge land border with Russia. That border has been closed for over a year because there's been this question of weaponizing migrants and sending them over the border. But then there's also this question, this is not just in the Baltic Sea and the border with Russia. The Germans, for example, have now said that the military is allowed to shoot down drones over German airspace because there's been a lot of strange drone activity around military installations, around industrial complexes. So this is something that they need to pay very sort of close attention to across the board, to say nothing of the sort of defense spend question. We heard from the NATO Secretary General speaking yesterday in Brussels before MEPs, basically saying, if you don't want to spend more on defense, you guys should get your Russian language books ready, because in 5 years, this is going to be a major problem for Europe. He says that 2% is just not going to cut it. Remember, Trump has asked for 5% in terms of NATO defense spend. He sees that settling around 4%. And then the question, of course, are always around that, how do you pay for it?
Ollie, fantastic conversation. Really interesting, particularly as well, because Verkunnen's got numerous hats. She's in charge as well of tech sovereignty, democracy in Europe, and sits really at the centre of this X platform investigation and Elon Musk influence in politics. What's she been saying about him as well?
Yeah, so listen, I mean, this is the thing. This is really one of the main things that's under her portfolio, and she is now directing the sort of investigation into the X platform under the Digital Services Act in Europe. This is the regulatory power that they have around these sort of platforms in order to discuss basically, is there undue influence and is there an unfair advantage being given to certain political threads, certain political perspectives on the platform. So that investigation, you know, on the X platform, broadly speaking, has been going on for basically over a year. What she said in this conversation that we had yesterday is that they're actually now looking at expanding that investigation on X in light of the fact that there is this German election coming up in just a few weeks, and of course everything that has been sort of his sort of support for the AfD. But there's also, for example, an investigation going on into TikTok because of its possible influence in what happened on the Romanian election. I think the other thing that is sort of going unsaid right now in Brussels, but I think is going to be a thread throughout this sort of administration, is the degree to which, and we heard Mark Zuckerberg make this reference to this to Joe Rogan over the weekend, talking about basically, he was referring to sort of European fines as tariffs on American tech companies. He was calling on Donald Trump to protect American tech companies from the European Union. To what degree is that going to sort of govern European policy? Will they go out a little bit lighter? Of course, no one who's sort of involved in regulatory circles will openly admit that, but that is certainly in the air here in Brussels.
Ollie, great stuff. Thank you very much indeed. Ollie Crook, after a fantastic conversation surrounding what could come next in terms of defence spending and how Europe figures out its borders. Let's carry on in some ways with a related conversation. Chinese officials are said to be discussing the sale of TikTok's US operations to Elon Musk. The app is said to, we understand, be banned in the United States on Sunday. This, of course, unless it is divested by its Chinese owner, ByteDance. We're watching the legal case proceeding very carefully. Bloomberg tech analyst Tamlin Basin joins us now around the table from Bloomberg Intelligence. This feels very speculative at the moment. Does it make sense that Musk would buy it? Is it logical that this would proceed down that route? What details are there actually about that possibility?
Right, and I think you're right. This does feel very speculative at the moment. And we also have a pretty tight timeline. On January 19th, TikTok is going to be banned pursuant to that legislation that was passed in the U.S. There was the argument on Friday at the Supreme Court. Certainly did not seem to go TikTok's way. So this could be sort of a last-ditch effort to sort of try to buy some more time. And the reason being is that they could potentially get a 90-day extension of that deadline if they can show that there are efforts being made to divest TikTok's U.S. operation. So I think that's the way we look at it right now, that this could possibly be a bid to go down that avenue.
Talk to us a little bit about just the response from ByteDance as well, simply because I think the last time we had you on, there was still a conversation of what American tech companies, not Elon Musk related, may want a piece of this. Amazon, Walmart, Oracle, et cetera. Does ByteDance have a preference here, or is this just all about cozying up to Donald Trump?
Right, and I think I saw some statements from ByteDance saying that this is not necessarily, they weren't agreeing with the reporting on this. They were pushing back a little bit. But I think for a lot of those companies you mentioned, that there could be serious regulatory concerns over allowing consolidation in social media to that extent. Walmart probably a little bit different, but certainly sort of the Meta, possibly even Amazon. It'd be an interesting question whether sort of Musk, who also owns X, whether his purchase of that would raise the same concern. So it'll be interesting to see if this proceeds, how that might garner attention.
Yeah, so potential other suitors, but if this TikTok ban does go ahead, could be good news for other social platforms.
Well, I think that's an interesting thing. If this does go ahead, it arguably decreases competition in the U.S. on social media. So this is actually an interesting case where potentially keeping it on the market in the U.S. could actually, further competition, at least in the advertising sector in social media.
Is there an issue with Musk buying it just because he's so close to the president? Would there be legal? How would it? Is that an advantage or a disadvantage?
I would probably look at it potentially as an advantage in this stage, only because if there was going to be pushback on it, it would come from the DOJ or potentially the FTC. We've already thought that there's going to be sort of less concerns on some competition in terms of consolidation under the FTC than there was under Biden's administration. Musk being very close to President Trump, President-elect Trump also saying he sort of shifted his stance on TikTok, where in the first term he obviously was one of the leading charge to ban it. Now he said he has a soft spot in his heart. So I think in this instance, Musk being close to the president could be an advantage.
All right. Okay. Tamlin Basin of Bloomberg Intelligence walking us through the tech story. This is going to be a fun one. We're going to see him more and more, of course, as we get more information around this. But it really comes down to the same concept. What is Donald Trump shooting for here in this era of deregulation domestically, but protectionism to the rest of the world? Is the approach that Bloomberg reported this morning of gradual tariffs the right one?
Balloons are clearly being floated, and we're trying to get a sense of what is happening within the White House right now. There is clearly a concern about the inflationary impact of tariffs. I think their story demonstrates that. Clearly, within the economic circles within the White House, there is a worry that if you put it all in at once, you are going to end up with an inflationary impact. We've learned, and the last election proved this, the inflationary impact and how that can show up in polling. So there's clearly some fear here. But there's also this instinct that Trump has surrounding tariffs and the impact and the positive impact that they can have. He talked about it when he talked to John Micklethwait, his biggest favourite word. He clearly is on board with the idea that tariffs should be used, and his normal strategy is to go big early. Not to go incrementally and gradually ratchet things up. The instinct that he has had in the past is going with both feet and then work your way back from there, rather than working your way forward to ultimately end up maybe in the same place. So it's clearly two different strategies that are being represented here.
But this story is a variation on a theme we've already heard. We had that Washington Post report saying that the Trump tariffs would be limited to critical industries.
And look what happened.
Yeah,
he came straight back.
Exactly. So the market reacted, then the moves reversed. Now it's about the pace rather than the targets. The market's reacted. Is it surprising that the market's reacted when it reversed last time?
But you know what's so surprising about this is how much how many people, how many CEOs and big names are hopping on the tariff train. Jamie Dimon, for example, on the Sunday show, talking at CBS, basically saying this actually might be an effective strategy to rebalance. He didn't say it was going to be 100% or he's going to, but it's I think the most pro-tariff comment I think he's made on record. A similar story with some of the tech names as well. Everyone's getting on board with Donald Trump.
Everyone fighting for their invitation to Mar-a-Lago. Zuckerberg and his fact-checking walk back.
So it's interesting that how the landscape is changing as quickly as it is. Are we ultimately heading towards some sort of Plaza 2, Mar-a-Lago kind of agreements that could change the global landscape in a significant way? Besson certainly talks about that. Truss is going to be speaking a little bit later on. We're going to get the first sort of inkling out of the new French government as to what kind of a deal has been done on pensions. It's a really busy day coming up. This time tomorrow as well, we'll have UK inflation data to fold into the narrative as well. It's a busy 24 hours coming up.
I think it was a Freudian slip. You said Truss, but you meant Reeves.
Sorry, Reeves. Did I say Truss?
Well, Reeves, Beirut, a little bit of Trump. We've got plenty to watch as well, plus the Senate confirmation hearings later in the week as well. 102 on Eurodollar, 122 on cable. Some strength in Europe today. Does it last throughout the day, as we, of course, have all of the things we just talked about on the agenda? That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Donald Trump's team is said to be discussing slowly ramping up tariffs to avoid an inflation spike while stocks gain. The dollar weakens on Bloomberg Story. Chinese officials weigh having Elon Musk acquire TikTok's U.S. operations if the app is banned. Plus, the Chancellor Rachel Reeves will address Parliament for the first time since the UK was rocked by market turbulence. Now, a little bit later on, we'll be joined by the former Legal and General Chief Executive, now Canary Wharf Group Chairman, Nigel Wilson, to discuss his outlook for the UK and to asset classes. That's at 9:40 a.m. UK time. But first things first, let's take a look at the markets. Now, there is a little bit of euphoria out there on the markets. Now, if you look at Europe, we're seeing a little bit of a leg up apart from the FTSE 100. Again, world stocks are rising as we have this report that Donald Trump's incoming team is considering a gradual ramp up of tariffs. Now, there'll probably be a lot of positioning and things that will change, but the tariff report knocked the dollar index lower after 5 straight days of gains. One of the key questions as we get into the Trump administration, again, inauguration is next Monday, is what kind of dollar policy will they try and have? Now, cross asset, we're not only looking at euro dollar, we have quite a lot of data coming from the U.S., including that inflation number. I'm looking at crude, Brent crude 80.84. Yesterday, we had a great conversation on where the price of oil goes from here. The Japan 40-year yield. Now, this is a story, it's quite a big move, but it's also a story going back to some of the volatility that we saw in bonds. Again, that has to do with inflation, with the Fed, and there's more and more cause for Japan to hike next week. The U.S. 10-year yield 4.7697. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, some optimism in the markets this morning on a Bloomberg scoop that members of President-elect Donald Trump's economic team have discussed a gradual approach to ramping up tariffs. Now, we'll discuss all of that and the market implications with Lucy Baldwin, Global Head of Research at Citi, in a moment. But first, let's get the latest from Washington, plus another Bloomberg scoop. Chinese officials are considering the option of Elon Musk acquiring the U.S. operations of TikTok if the company is forced to sell. Let's bring in our EMEA News Director, Ross Matheson, and Bloomberg's Executive Editor for Technology, Peter Elstrom. So thank you both for joining us. It's a regular occurrence to try and figure out what's happening in tech and what's happening in Washington. Ross, we had this Bloomberg scoop about the Trump tariffs. I'm surprised at the market reaction. I don't know what they like, the fact that it's gradual, and so it's a bit more, it's less blunt than the kind of I come in and I do tariffs. So does it assume that Donald Trump and his team will then, try and weigh the impact the tariffs have?
I mean, the most striking thing is really this is a proposal that some of the people in his team seem to be cooking up. You can see the hand of the Treasury Secretary nominee Bessent in this, and really what it suggests is that there could be cooler heads prevailing around Trump in general on this issue. Let's not go out too hard on tariffs. I mean, really the impact on inflation, whether you go bit by bit, is it that gradual, really? So it's interesting to see the market reaction, maybe less on the inflation side, but really the idea, again, that you will maybe have that group of people around Donald Trump who will be urging him to go carefully on this. And so you start with something on tariffs. Maybe it's not massive. You start with something. You see the reaction. Does that prompt any kind of behavioral change? The warning, you could do more if needed, but you kind of stop at any point doing something blockbuster and then having to try and unwind that. So it does suggest some pragmatism, perhaps, in the way that tariffs might be approached. Again, it all depends on whether they can sell this to Donald Trump, what he wants to do. Again, this seems to be a proposal they'll put to him, but maybe the pragmatism part of it is really what is filtering through to the market reaction today.
Yeah, and apart from economic policy, I think we'll spend a good amount of time trying to figure out the relationship between Elon Musk and Donald Trump. But there's this Bloomberg scoop today saying TikTok, if they get banned from the U.S., are also thinking of maybe being sold to Elon Musk. I mean, what do we know?
Yeah, that's exactly right. Well, what we understand from our sources is that senior government officials in Beijing are talking about a variety of options if TikTok is actually banned in the United States. We're only days away from this congressional ban going into effect. That would be January 19th. The Supreme Court had some emergency hearings to hear whether they would stay that ban. They haven't issued a formal decision yet, but it does look like they're probably going to go ahead with the ban at this point. So we understand that they've talked through in Beijing a number of different options. One of the options that's kind of appealing to them is that perhaps they would allow ByteDance, the parent company of TikTok, to sell the TikTok U.S. operations, just the U.S. operations, to Elon Musk, perhaps combine it with X to be able to run the operations together.
I mean, is that problematic, the fact that he's so close to the president and would have such a, big thing under him?
Well, I think from the perspective of Beijing, it's probably not problematic. It's probably an asset. As Roz was just describing, the Chinese government, the U.S. government are going to negotiate many different things, including tariffs, export controls, and a whole bunch of other things. And it may make some sense for Beijing to be able to cut some sort of deal with a Trump ally, as close of an ally as Elon Musk is, and work out some sort of deal where TikTok ends up in hands that are considered closely allied with the president.
So, Ross, we've also had a final report from former special counsel Jack Smith, and he basically talks about, the fact that Trump illegally conspired to overturn the 2020 elections. What did we actually learn?
Well, it's interesting because most of what was in the report is things that we already knew. I mean, it's basically the claim that Donald Trump leaned very heavily on his then deputy Mike Pence to avoid congressional ratification of the election result and really tried to prevent people from even talking to Mike Pence. So the nuts and bolts of the report really aren't that new. Obviously, the conclusion, that Trump may have been liable for prosecution and conviction, if it had gone that way without sort of immunity, would have been a factor. And it came out, obviously, in the middle of the night because they were clearly trying to get this report out before any further action from Camp Trump to try and stop it. Does it change anything? I mean, if you believe what you believe about January 6th, you kind of still believe it. It's not going to change perspectives of Americans about how they feel about this event and this day and what happened, and Donald Trump in particular. Can he use it as leverage again with his base? Possibly. Does it change things given it's kind of backward looking now in nature? No. But it's interesting to see that they did manage to get it out just in the days before Donald Trump actually takes office.
Roz, there's also been murmurs and talk about 30 hostages still being held in Gaza by Hamas being released as part of a ceasefire deal. I know, again, there are questions on whether it's thanks to Trump or thanks to Biden, but they both seem pretty optimistic that a deal can be done.
Well, that's right. Things do seem to be building towards some kind of at least framework, understanding. They obviously want something they can shake hands on, for want of a better word, before Donald Trump takes office, and that would allow Joe Biden, in a way, to claim, look what I managed to do right before I was out the door. So there's a strong vested interest here from both Joe Biden and Donald Trump to get something done. The question is, what does that then mean for the actual region that it's about? Is it fragile? Is it lasting? Does it change the dynamic in the Middle East? Probably not. Is it going to be lasting? There'd be big questions around that. But at least, it does give a pathway forward. The question is, what changed Israel's mind here? Did the US give something or promise something to Israel to get Benjamin Netanyahu to agree to whatever this framework might be?
Peter, very quickly, even if Elon Musk doesn't end up buying TikTok, does it change, if TikTok gets banned in the U.S., does it change everything for social media platforms?
Well, it certainly changes the dynamics within the country. TikTok has been such a popular platform. What we're seeing, actually, is the rise of some alternative Chinese apps, actually, though. There's one in particular, Xiaohongshu, XHS, which has become very popular within the U.S. It's an alternative. It allows you to do many of the same things as TikTok does. It's also under Chinese ownership. So the U.S. government officials may find that if they ban TikTok in the U.S., if they push people off of this platform, they may move to another platform that's also owned by a Chinese company in the background with the same kind of risks that you're seeing with TikTok right now. So those dynamics need to be tracked pretty closely.
And we haven't even started talking about Mark Zuckerberg, so much to decipher. Thank you both for joining us, Peter Elstrom and Ross Matheson. Now, coming up, we'll discuss the market impact of the latest Trump tariff news with Citi's Lucy Baldwin. Plus, also the French Prime Minister is set to present his policy agenda to Parliament. Details ahead, and this is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Well, welcome back, everyone. With me now, Lucy Baldwin, Global Head of Research at Citi. Lucy, so good to speak to you. I mean, there's a lot to unpack because the markets really move on any kind of news about even this Bloomberg scoop, Donald Trump maybe phasing in his tariffs. I don't know what you're expecting or whether it's just kind of like blow by blow. We'll have to see what President Trump has to say.
Well, you're absolutely right. Q1 is going to have a huge amount of policy uncertainty, not least with tariffs. And of course, tariffs in many ways is, Francine, that big wild card, isn't it? Yeah. And when we've thought about tariffs and the sort of potential for the impact that it could have on the earnings of the S&P 500 this year, very broadly, if we went down the path of a broad tariff around 10%, we think that's about a 6% kind of earnings impact, which is quite significant, of course. But I think in reality, we're going to have to see how this all goes. And when we add up all the different policy impacts that you might see coming in over the course of the next few months, we think probably in reality, in aggregate, we're talking about a couple of percentage points either way to our expectation for earnings growth, which in aggregate for the S&P this year is about 13%. So yes, of course, certain stocks, certain sectors, it's going to be more material, but probably once we get through this uncertainty, that's the sort of order and magnitude we'd be expecting to see.
I mean, the Fed is a lot more cautious, certainly when it comes down to curbing inflation. They've been cautious for a while, but the markets are really only latching on now. Is that, again, because of the tariffs effect being inflationary?
I think you're absolutely right. Wherever you look in the world, there's this debate at the moment as to whether the concerns that we're seeing in bond markets is driven around, is this a better economy? Is this a much stronger jobs market that we're seeing? Or is this actually all back to electoral politics and policy and what that feeds through into markets? And I think in truth it's going to be an element of the two, right, that are starting to feed into everybody's psyches, whether it's CEO of companies, whether it's policymakers at central banks.
But how much should we worry about the health of the labor market? Again, that changes dynamics. We've seen, the 40-year in Japan, the highest it's been since in more than 20 years. We've seen huge moves in the UK. I mean, all of this, the catalyst was the US.
Yeah, absolutely. That's definitely the epicenter of this, right? But as you say, there's so much government debt everywhere. The origins of lots of these things come back to different government plans. So like in the UK, obviously, things do come back a little bit to that budget that we saw. But you're right, that the crux of it all always goes back to how good is the labour market and is anything going to jeopardise that, right? And I think in the US, the labour market still looks incredibly strong. We had that amazing jobs print, and I think that's meant for a lot of people that they think there's absolutely no chance that you're going to see, therefore, any movement in the Fed following that in terms of cutting. And even our economist, who is naturally much more nervous about the labour market and is convinced that we will start to see it unravel this year, he's actually had to also say, look, I'm going to push this back, right? So he's now not expecting to see the Fed move until May. So I think that is definitely the debate that is unraveling everywhere, is where can you see those cracks emerging? I think here in the UK, you are starting to see more cracks in the labour market. I think there is more concern around the cost of labour, and you're seeing those intentions around what's going to happen to hiring, etc., really start to soften. So I think for everybody, watching the health of the labour market, wherever they're invested, is going to be really critical this year.
Lucy, through all of your research, is it volatility, the word of 2025?
It does feel like that, doesn't it? If 24 was all about risk on in every sense, right? This year definitely feels as though, because of the starting point, we're really, really attuned to any risk, right? And I think there are so many potential risks now that are forming around the globe. Our big message to clients is the sort of only free lunch, I guess, in investing, as they say, is diversification. So it's diversification across asset classes and within asset classes. And I think what we've been saying, certainly, towards the back end of last year around the big US equity market moves that we'd seen, was, look, you've got to be really cautious here that is going to be very difficult to keep repeating. And ultimately, yes, it has worked for the last couple of years now, being heavily invested in the Mag 7. But as we come into 25, given how many risks there are, you've really got to think about that diversification strategy.
Yeah, let's also talk about France now. The leader of the left-wing socialists say his party may be near an agreement with the government, raising the chances that Prime Minister François Bayrou will be able to pass a budget. Now, Bayrou is due to present his policy agenda to Parliament this afternoon, so let's go live to Paris and Bloomberg's Caroline Conan. Caroline, great to speak to you. So what are we actually expecting from the speech this afternoon?
We expect him to talk about immigration, about the budget that he's planning to present by mid-February. But now, and that may surprise you, Francine, the most important thing we're expecting him to talk about is the pension reform. This pension reform was adopted back in 2023 after months of protest, raising the retirement age of the French from 62 to 64. Now, you wonder why this is coming back on the table. That's because the socialists have made this a key point in order to support or not support a vote of no confidence against the new Prime Minister, François Bayrou. We heard from the head of the Socialist Party, Olivier Faure, fueling optimism on the bond market this morning, saying we might just be a few hours away from some sort of agreement with this government, a sort of pact of non-aggression from the socialists against this new Prime Minister, François Bayrou, which of course is very important because of this uncertainty, this instability we've seen since the snap elections back in July. Remember, his predecessor, Michel Barnier, only lasted for 3 months. So we'll watch very carefully what exactly François Bayrou says about this pension reform, whether he actually pronounces the word suspension. His entourage is saying that perhaps he's looking for a different word, some kind of new financing instead of just suspending this pension reform. But that will, of course, be key to see how long François Bayrou can survive.
Caroline, thank you so much. Caroline Conant in Paris. I mean, Lucy, when you look at Europe, we have, so France, many question marks. You have, of course, the German election, February 23rd. What do you do with Europe right now? They seem to be in a favorable position in terms of interest rates compared to the UK, but actually growth is looking pretty dire.
Yeah, look, I think what you have with Europe is some hope, though, Francine, right? And I think the way we've tried to talk to clients about investing in European equities, for example, is very much on that basis, right? So we've said, look, we're at the end of probably late cycle in terms of markets, right, in terms of valuation set up globally. So you want this barbell approach. So yes, US equities might be cool for everybody, but guess what? There's European equities that offer this cyclical diversification strategy. And I think there is a lot of quality in Europe, and I do think now's a good time to have a look. Obviously, last year we saw Europe underperform the US by its biggest margin in a really, really long time. So I think that could set Europe up very nicely. And of course, there's a number of catalysts in Europe, not just sort of political reform, where I think there is tremendous possibility, potentially to almost go down a US type of path in terms of deregulation and some other things that could come through. But I think if we had that alongside maybe some resolution to some of the major conflicts in the world, maybe some movement, therefore, in terms of energy pricing and strategy around that and how we're going to fund the transition, to the comments just made around pension reform, things that might encourage some innovation back in Europe alongside that deregulation, I think those could be really, really positive. And of course, China, which is a massive wild card for global markets all in. And I think if we do start to see that more material stimulus come through, which you would expect to see at some stage, once we get through the inauguration, then I think that could be another set of catalysts for Europe that could start to see the market perform better.
Okay, so interesting. So not a lost cause. We'll get back to that in a second. Lucy Baldwin from Citi stays with us. This is Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech. Welcome back, everyone. Now, our big Bloomberg scoop is the fact that Trump's incoming economic team may be considering a gradual ramp-up in trade tariffs. Now, that would mean that possibly cooler heads prevail, but also it could avert some kind of inflation spike. We're back with Lucy Baldwin, Global Head of Research at Citi. Lucy, I mean, the one thing that matters is what happens to the dollar, but also probably more importantly is what happens to U.S. equities this year.
Yeah. Well, look, I think when we consider the S&P 500 for 2025, our view, Francine, is despite these very elevated valuation levels, we do still see, as we push through the year, about 10% upside from here. We've got a 6,500 target in. However, what I would say is we've got a bull case, which is 6,900, and a bear case, which is 5,100, which is giving you a sense of that asymmetric reward that we're seeing, right, and the risk to the downside. So, you know, we are telling people to sort of hedge, protect some of these positions that they've got. But I think when you look at the S&P 500 for the year, you know, the big debate with clients is going to be, can the Mag 7 keep performing? Can they deliver this beat and raise again this year like they did through 2024? And what about the other 493 names?
Yeah, but that seems actually a little bit, you know, I guess more resilient to the tariffs. Is that fair?
Yeah, look, I think that the tariff piece in reality is going to be a small impact in aggregate to those earnings. Yeah. But I do think from a sentiment perspective, it's going to be really, really critical. And for certain sectors, right, I think the news that we get in the early part of this year, for example, this week we're coming into financials earnings season. Financials has been an overweight for us and many others. But in reality, a lot of it's been on euphoria around potential regulatory reset. So I think there's a number of big tests for the market as we go forward, hence the mantra that diversification is going to be key.
Well, Lucy, as always, thank you so much for joining us. Lucy Baldwin, they're Global Head of Research at Citi. Now, coming up, U.S. companies increasingly turning away from their diversity, equity, and inclusion practices. We'll discuss that next with Miranda Braun, the Miranda Braun Diversity Leadership Foundation, of course, CEO. This is Bloomberg.
why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. Now, Donald Trump's team is said to be discussing slowly ramping up tariffs to avoid an inflation spike. Stocks gain, the dollar weakens on Bloomberg story. Chinese officials weigh having Elon Musk acquire TikTok's U.S. operations if the app is banned. Plus, the Chancellor, Rachel Reeves, will address Parliament for the first time since the UK was rocked by market turbulence. Now, Southern California faces another round of dangerous fire weather, even as crews struggle to contain wind-driven blazes that have paralyzed Los Angeles for nearly a week and killed at least 24 people. The disaster is expected to be among the costliest in U.S. history, with estimated damages and losses between $250 billion and $275 billion. Now, for more, let's bring Bloomberg's Joe Wirtz. Joe, thank you so much for joining us. So what more do we actually know about the likely damages from the winds and fires?
Yeah, the damages are going to be extensive. I mean, it's worth noting that the fires are still burning. A couple of the big ones basically out of control, so the crews have not been able to come in and fully do an estimate, but we're talking thousands and thousands of buildings. Like you said, billions of dollars in damages. We're looking at, one of the most destructive, most damaging disasters in California history, at least, dating back to the 94 Northridge earthquake. So these will continue to mount, and also looking at a ton of damage to infrastructure and things like that.
I mean, I know a lot of the pictures on social media are definitely apocalyptic. What have officials been saying about the recovery and actually the rebuilding story? Yeah, look, this recovery is going to take years, just in the losses alone and figuring out exactly what was damaged and who's going to pay for it. Governor Newsom and the federal officials in the U.S. are clearing out, billions of dollars to try to get this going as quickly as possible. But they are still actively fighting these fires and really haven't been able to get in and do a full damage assessment. And today we've got another really dry, windy day out in Southern California. A lot of real potential recipe for those fires to keep going, to spread even more. So the destruction, the damage, big, enormous, and likely to keep climbing. All right, thank you so much, Joe Wirtz, of course, for the update. We'll continue bringing you up to the hour minutes, of course, on the story. Now, the EU is considering expanding its investigation into whether X broke content moderation rules. Elon Musk's social media company is accused of failing to tackle illegal content and disinformation. Now, the Commission's top digital official told Bloomberg they're looking at whether a live-streamed conversation between Musk and Germany's far-right leader gave a political candidate an unfair advantage.
With X, the investigation has been already going on 1 year, and it's quite broad. the scope that Commission is investigating, and now we are currently assessing that if the scope is large enough. Also, when it comes to these upcoming German elections, that we are covering already all the risks on that.
Well, we'll also be speaking to the EU's Climate Commissioner, Wopke Hoekstra, the High Representative for Foreign Affairs, Kaja Kallas. Catch those interviews here on Bloomberg TV tomorrow. And the SEC is extending its crackdown on Wall Street's use of text and other messaging apps for business that is supposed to be monitored and archived by employers. Now, affiliates of Blackstone, KKR, Apollo, and Charles Schwab are among a dozen firms that will collectively pay more than $63 million for failing to track employees' use of unauthorized communications platforms. Well, the case come just before President-elect Donald Trump's administration takes charge. Meta and Amazon have become the latest U.S. companies to scale back their diversity and inclusion efforts. Now, they've joined corporates across the country, including Walmart and McDonald's, in a retreat from DEI policies. Now, it's not yet clear what this means for companies in Europe, whether the gender pay gap is widening for non-executive board members in financial services. Now, we're joined by Miranda Braun, founder of the Braun Review into Boardroom Sustainability, Inclusion, and Corporate Governance. Miranda, thank you so much for joining us. We're 6 days away from the Trump inauguration. You've done immense efforts to try and explain and also highlight some of the things that corporate America has been doing to try and make a difference. Is there going to be a crackdown on some of these policies? Are we going to see a reversal or a stagnation?
There's definitely a crackdown. I think we've already seen with Meta on Friday, who have announced that they're actually drawing and they're cutting back on their diversity, equity, and inclusion programs. We've also got Amazon. We've got so many other US large corporations who have cut back. But I think on the positive side of things, we do have Apple, who have recently announced that they're very secure with their compliance structure, and they do believe that when it comes to diversity and inclusion, it's a must-have for the business arena. But it is concerning, and I think lots of organisations, they are fearful. There is anxiety, and so I think that's what we're seeing. And I think when we look at the legal and political arena, these are some of the reasons why these large organisations are saying that they want to cut back on diversity programmes. But I think we've also got to look at some of the solutions and some of the things that are legal when it does come down to the new Trump term. And some of the things that organisations can still do that will still be legal will be coaching and mentoring programs. There will be the structured interview process. There's also making sure that the interview process is also biased. So there are lots of things that organisations can be doing. But I think at the forefront, and this is what we've been researching at the Braun Review, is making sure that organisations are sustainable and inclusive. What I've noticed, though, having conversations with various global leaders through the Braun Review, through lots of research that we've done, is that at the start of 2020, when we launched the UK's first Black Women on Boards, there were lots of calls. There were lots of CEOs and board directors asking for recommendations. Sadly, over the last few years, that has slowed down. So I think we might see a trend of people maybe fearful of the new administration coming in. And when we look at the Trump's appointed judges, I think that's also going to affect the law, the actual legal cases taking place, putting my lawyer's hat on.
Miranda, do you think, I mean, is it because they're afraid of retaliation?
They are.
From the Trump camp or actually from the followers or Donald Trump?
Well,
or would they still be quietly doing it?
Well, one of the advice would be to quietly do it. You can have control within your own walls. So for any large corporation that might be fearful of the backlash from Trump's administration, and when you look at this is from the public perspective, but from private companies, this does not affect that. So any of for example, when you look at the US Supreme Court 2023 for students of fair administration, or when you look at the US Court of Appeal, they actually rejected the ruling for NASDAQ when they said that listed companies, they need to have at least one woman, one person of colour, or an LGBTQ plus person. They actually rejected that, but organisations can still, within their own remit, push forward when it comes to diversity and inclusion. I think that's so important. But on a positive side, I think within the UK, we're still pushing forward. So many of my guests who are board directors on the DARE podcast, they are still very much positive. They're still moving forward. They've got the Apple mindset. But I think it's going to be very interesting with the Trump administration to see what is the backlash And also, when it comes to diversity and inclusion research, there's so much research that's been out there that shows that it makes an organisation more innovative and more profitable. Yeah. So all of those organisations that are, like Meta, that are pulling back, you've got WhatsApp, you've got Facebook, you've got Instagram. What are their global users going to be doing? Are they actually going to be choosing someone that's more in line with their values, especially from a diverse global user base? So I think the next 6 to 12 months is going to be very interesting. And what other organisations are going to be joining? For example, what's Netflix going to be doing? What's Google going to be doing? This might also impact the technology industry.
Miranda, what's the Apple mindset?
Well, the Apple mindset is literally what they're saying is, and it's my mindset, they're saying as far as they're concerned, when it comes to diversity and inclusion programs, this is actually beneficial. This is actually something that brings profits to the table. So they're very, very confident that as far as they're concerned, when it comes to the other organisations that are scared about the legal or the political risks, Apple is saying, well, as far as we're concerned, we've done our checks and balances, and we're very confident that we've got a very secure very confident with their compliance program.
And when you look at Europe, I mean, there's shifting politics, right?
Yes.
Everywhere in Europe. So it's here in the UK with reform getting much more the right wing, also in Germany doing quite well. I don't know whether this goes back to actually wokeism and whether there needs to be a rebrand, that there's a confusion between some of the DEI initiatives and woke, which means different things to different people.
Definitely. And I think there is this thing of I'm not pro-woke, I'm not anti-woke. And what is woke? I mean, it goes all the way back to the civil rights. And what is woke? It's about pushing for meaningful change. It's about having values. But I think maybe there is a need to rebrand this woke term. But when it comes back to diversity and inclusion, I think one of the things that I'm doing in the global boardroom is actually having conversations with CEOs, having conversations with board chairs, and advising them and letting them know that it's whatever hostile environment is taking place externally, what they can do internally is actually let's regroup. Let's have a look at what's working from a diversity front. Because I think lots of people are saying, well, we've been pushing all this diversity program, the agenda, and it's not working. But it's what exactly have you been doing? So I think it's really important to go back to the purpose. Why are you doing this? What is the commitment? What is the vision? And maybe we tweak that. But I think additionally, it all comes down to culture. We've spent so many years getting diversity within the organisations, getting it in the boardroom. We don't want to waste this hard work. So I think it's so important to have global leaders actually use their voice. The voice is the most powerful platform. And I think what global leaders can be doing is not only making sure that their organisations are fully inclusive, which is what the Braun Review is all about, but also making sure that they use their voice to speak up about diversity, equity and inclusion programmes.
What about the UK government? They've been in charge for about 6 months.
Yes.
Are they doing enough, or are they shying away?
Well, I've got connections with the UK government, and I think there's always more that we can be doing, but I think they're very much focused on the healthcare, diversity within the healthcare. There's a lot more that we can all be doing, but I think they're definitely on track for the right direction for diversity and inclusion. But I think when you look at the UK and Europe and other continents around the world, I think all eyes are on the US at the moment in terms of what is going to happen once Trump does come in for his second term. But I think when we look at diversity and inclusion for the last year or two, since I started the Braun Review at Oxford University, where I was their visiting fellow, we have noticed that there is a drawback. I mean, I've mentioned that the calls have dropped in terms of global leaders, chairs, CEOs asking for recommendations to hire diverse candidates. But I think we've also got to remember that when it comes to diversity, equity and inclusion programs and initiatives, this does make financial sense. So short term, medium term, it'll be interesting to see the organisations that do shy away from diversity and are cutting back versus the one who are brave and have the courage to continue with that commitment. What are the profit levels going to look like? What are the innovation numbers going to look like? And also from a consumer perspective, what are the consumers going to be doing? Is there going to be a backlash?
We'll see. So many questions. Thank you so much, Miranda, for joining us today.
Thank you.
Miranda Braun, the founder of the Braun Review. Now, coming up, we'll be joined by Nigel Wilson, the former chief executive of Legal & General, now chair of the Canary Wharf Group, for his take on the UK sell-off. We'll talk economy, we'll talk inflation, we'll talk gilts. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Bloomberg Invest is back. Join me, Sonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
We do not have a weak pound. In fact, if you look at the trade-weighted value of the pound, I think it's actually risen over the past 15 months and has been pretty stable since the Labour government came into power.
That's Jim O'Neill, the former chair of Goldman Sachs Asset Management, pushing back against claims of a weak pound. Now, for more on the UK outlook, we're joined by Nigel Wilson, former chief executive of Legal & General, now chair of Canary Wharf Group. But Nigel, as always, thank you so much for joining us. Look, for me, it's undeniable that the UK somehow became the epicenter of a sell-off because there are question marks about growth, inflation. Is it the Chancellor's fault?
No, it's not the Chancellor's fault. I think there's the budget was a bit of a surprise and was seen very negatively by business, particularly the increase in NIC, which is a £25 billion hit to the business sector, and obviously confidence erodes as a consequence of that. And I think the main reason is we're still tracking America. You know, American rates have moved, our rates have moved in parallel. We're competing for that capital right now. But we are 50 points ahead of what the OBR forecasts, brackets, and you could take that as a proxy for the Treasury. You know, rates are about 50 basis points higher at 5-year and 10-year than was put in the plan, and so we're not way out from where the OBR numbers were and the Treasury numbers were, but we're at the outer edge of that, and the economy is not growing as fast as we thought it was going to grow, and we're not seeing investment pull through in the way that we thought it would pull through. So,
Nigel, again, what's the right thing for the Chancellor to do now to get ahead of it, if she can?
Well, I think she has to go back to the growth agenda. That was the one that people were expecting. Said we had quite an ideological budget in education, in health, and in many other areas when we needed a growth budget, and business was looking for that. The city was looking for that. You know, we're not over-leveraged in the UK. The GDP, debt to GDP ratio is still under 100. You know, with the only Germany has a better ratio than we do. So we have a lower stock than everybody else, but the flow into the gilts market is unprecedented. We've got 300 billion of gilts, which have to be sold this year and indeed next year. That's 10% of GDP, which is the highest in the G7. Our investment to GDP is the lowest in the G7. So it's very unlikely if you've got the lowest investment, you're going to have the top of the GDP and G7 in terms of growth, and that's clearly not where we're heading at the moment.
But, John, I mean, there's market concern now. So does the Chancellor wait until spring and do something extra on growth or even cutting spending, or she needs to come out? Would that not so panic if she came out and
said, she's definitely got to come out. I mean, you've got to respond to what's in front of you now and actually talk about the growth agenda. And I would be very surprised if she doesn't do that in the next 3 to 4 weeks and clarify some issues which were raised in and around the budget. And, you know, I'm sure the Treasury is working on that right now, is that we have to have a sense of where we're going to really grow the the economy and not wait until March, April, May, June, which is the current timetable.
But that's what extra investment that requires more debt.
I think they've got to stop the narrative. It's all about the government investing in the economy, and it's the National Wealth Fund, and it is all this other stuff. The government's not great at running the big projects. HS2 is probably one of the worst projects we've ever had in the last 100 years in Britain. So we need other big companies stepping up and saying they're going to invest more in growth in the UK. And we need the planning reforms and the pension reforms to actually happen. And actually we're seeing minor changes at the moment in planning, but it's still a system that's incredibly slow, particularly compared to America. And we have judicial review after judicial review of all of our big projects in the UK, and they just take too long. In the low interest rates, that costs this amount. In high interest rates, it costs this amount. And so we've got to recognise that actually these delays are really costing us money and turning people away from investing in the UK.
But Nigel, is that, I mean, again, the problem is always one of timeline, is that even if you announce this, it takes, the market is worried about things that are more immediate. Yeah, they're worried, but they're not overly stressed. This is not like the LDI crisis, the trust Kwarteng crisis that we experienced before. This is that we're at the outer edge of what we thought was realistic, and the pound's a bit weaker against the dollar than we thought. The rates are higher than we thought. Growth is lower than we thought. So she's got to be acting very positively and engage with business on this. I mean, the NAC took us all by surprise, and we don't want to see a repeat of additional taxes and more government spending and actually not enough business investment. That investment to GDP ratio is really low. We need about an extra £100 billion of new investment, incremental investment in the UK to get anywhere near the growth targets that Labour set itself. Nigel, thank you so much. Nigel Wilson, of course, stays with us. We'll have plenty more on the UK. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back, everyone. Still with us, Nigel Wilson, former Chief Executive of Legal & General, now Chair of Canary Wharf Group. Nigel, thank you so much for sticking with us. We were talking a little bit about the dynamics of UK growth and assets and what the Chancellor could do. We're also 6 days away from Donald Trump getting into the White House. Does that complicate things?
No, I think it's going to help things, because what Trump has been brilliant at is he uses credible threats and comes back down from them to a more sensible solution. We give credible promises and actually can't deliver them, and therefore one creates unhappiness and the other one's going to create a bit more happiness. And I think that'll be good for the UK, because I expect gilt rates to fall and treasuries to fall when we see Trump come into office and implement some of the tariff plans and some of the Greenland, Canada and Panama Canal takeovers and immigration, and we get a more realistic and pragmatic solution to those issues, and that'll have a positive effect on the UK.
What does that mean for, you were saying, you know, the prism of communication with the UK government, the US, is completely different. Does that matter to investors?
I think it does matter to investors, because, you know, and again, I think that matters with Europe as well, is that we've neglected communication and building relations across the world, I think, for the last 10 years. And Keir has actually done a good job of actually rebuilding some of those relationships in the last few months. We have to work much harder at all of this relationship management than we have done in the past. There's a huge opportunity for the UK. We've still got that $6 trillion of long-term capital, which is the highest ratio in the world to actually invest, and too much of it's in cash and gilts and other things, as we know. We have to invest in growth equity to deliver growth companies, to deliver overall growth for the economy.
But this would be part of the capital markets reform. I mean, is that enough? Because again, you look at the I guess pensioners will have to take on more risk, which doesn't come naturally.
If you look at risk on a one-year basis, but actually you're taking risk over a 10 or 20-year basis, actually when you look at taking risk over a 10 or 20-year, these are the right things to do. These are low-risk, better return options for both at an individual level, but actually at the country level. And we've got to be bold. We've got to actually stop tinkering and making all these tiny little changes to taxes and everything that irritate everybody, and actually focus on how we're going to deliver growth, how we're going to get growth capital, including from America. America is a great sponsor of growth capital here in the UK.
Is there anything that the Chancellor needs to just get rid of that was just in the budget 3 months ago?
I would have got rid of several things that were in the budget a few years ago. I think there's lots of things that she's committed to do, and I don't think she can roll back from those. But actually, making planning reform happen, getting rid of making pension reform happen, and actually getting the confidence of both the very big companies in the UK, but also the growth companies in the UK. And that got eroded during the budget process and the communications thereafter.
Nigel, thank you so much. Nigel Wilson, there, former Chief Executive of Legal & General, now Chair of Canary Wharf Group. Now, you can also find out how the UK bond market could impact personal finance at a live Q&A on Bloomberg.com. That's today, 12 p.m. London time. Up next, Bloomberg Brief, Danny Berger and Manus Cranny in New York, and this is Bloomberg.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670 odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, why haven't, we're owning this space.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
A gradual approach. Incoming President Trump's economic team is said to be considering a slow ramp-up of tariffs. That Bloomberg scoop sends the dollar lower to snap a 5-day rally and eases a global bond market rout. And a backup plan for the TikTok ban is a potential sale to Elon Musk. More on that scoop coming up. Good morning, Manners.
You couldn't make it up, really, could you? Danny, look, we are grasping at gradualism. Equity markets have turned around. We're up 0.7% on the NASDAQ. What do we mean? 2 to 5% tariffs on an incremental basis over a number of months. That's the story, the Bloomberg scoop. We were at the point of wiping out the Trump bump in equity markets. Of course, we'll know a little bit more about the fourth quarter earnings when JP Morgan and Wells Fargo deliver. But the equity market smelled the burning in the bond market, which has paused for now. Let's just roll it over, have a look at this. This relentless, this breathless move in yields has, well, we're back to flat 477 on the bond markets. By the way, you know, P. Jim has sort of said there was a tantrum-esque style to these bond markets. Of course, that's referring to the Ben Bernanke taper tantrum when we moved 50 basis points in a month. But we'll talk more about those tariffs in just a moment.
Well, that easing of the bond market route, helping out the mega caps. NVIDIA, we're keeping our eye on that. It had fallen 10% over 4 days. It's rising in the pre-market session this morning. It is rising by about 2%. The Central News Agency reporting that it plans to establish its Asian headquarters in Taipei.
Coinbase, another stock with tracking, and other crypto stocks rising after the SEC provided insufficient justification for rejecting its proposed crypto rules.
And Teladoc, that's also rising in the pre-market session, saying that its programs will be accessible via Amazon's Health Benefits Connector, a nearly 10% rally.
A feast of stories to delve into today. We've got Michael Gaffin from Morgan Stanley, and later in the hour, Nancy Tengler joins us from Laffer Tengler Investments. Danny, grasping at gradualism. This is a Bloomberg scoop, and it's about the process and the cadence of tariffs that could come to bear.
And it's a market that's interpreted it as positive. Maybe it just goes to show how far this bond market rout and dollar rally have gone. But one, if we do get something like 5% tariffs per month, that sounds pretty aggressive. Something like IEEPA, this is what Deutsche Bank points out, that's used really easily by the president, can allow him to put it on more easily. And UBS also arguing that then the Fed can't treat it as a one-off price increase. It would be a rolling price increase, and that's problematic for them.
It also sounds sort of abstract. You can sort of imagine at Mar-a-Lago, you've got Scott Besson talking about the bond market, which is sort of a little bit of a smell of burning, and then you've got Howard Lutnick. So you've got different camps at play in Mar-a-Lago. Can you imagine President-elect Trump seeing this as being the shock and awe policy that he wants to deliver to the world, rather than incremental levels of pain? That's open-ended levels of pain, I would say.
I think that's such a good point. This is the line that I pulled out from this Bloomberg scoop. The proposal is in its early stages and has not yet been presented to Trump, the people said. We could very well get a post from Trump, like we did after that Washington Post story, saying this isn't true, this is not what I want to do.
But definitely different camps involved in this. Let's take the Bloomberg scoop to Michael Guppin, Chief U.S. Economist at Morgan Stanley. Michael, good morning to you. So here's the debate, fresh off the rails from Bloomberg. Incremental tariffs at 2 to 5% per month. Is that more painful than shock and awe and a definite one-off blast of tariffs? Good morning.
Good morning. No, in the extent that if you thought comprehensive tariffs right out the door, that would be very disruptive. But I think, as you're hinting, I'm not sure gradualism is all that different. It delays it. You can still get to the same ultimate endpoint. So yes, it maybe bakes in more slowly, but to your point, 2 to 5% per month can still be a lot. And the problem here, as you know, is that it'll show up in inflation first, but it tends to hit activity later. So how do you know exactly where to stop, even if you're moving gradually?
In that case, if it does end up being the case, Michael, and as we've said, we don't know if it's the case until Trump confirms it or doesn't confirm it, how would the Fed react to such a policy? How would it try to incorporate it into its outlook when we've already seen a Fed that's been very divided as to whether or not to include politics in its outlook?
Right. I do think you got a little hint of that at the last FOMC meeting, where at least some participants baked in expectations of policy. And there, I think the signal is, if we do get widespread tariffs, even if they ramp up gradually, it will likely halt the disinflation decline. Nobody was projecting on the committee that inflation would turn around and reaccelerate, but I think you definitely got the feeling that it might halt the decline in disinflation when they appear. And therefore, the Fed's likely to move to the sidelines. So I think what we would say is there is a balance here. Over time, tariffs would likely weigh on trade volumes and activity. So the Fed may ultimately cut, but it would have to see how inflation is evolving. So the Fed moves to the sideline. They stop their easing cycle, and then maybe they resume their easing cycle later if the economy slows, as their prior analysis suggested when tariffs come into play.
And this bolsters your view, Michael, that we go towards stallflation, but we return to disinflation over stagflation.
It does. When we look at tariffs alongside immigration policies, those two things are likely to come first in 2025, with deregulation and fiscal policy maybe coming later. Yes, you get the kind of more immediate effect on inflation. Maybe in 2 to 3 months, tariffs show up in inflation, but in 2 to 3 quarters, they start to weigh on activity. Ultimately, then the Fed will likely say, okay, should be a one-off impulse to inflation, even if it's a series of one-off impulses. And the weakness in activity should dominate later. So yes, it's the Fed that moves to the sideline, but then ultimately resumes cuts.
Michael, there's been some commentary this morning that perhaps why we've gotten this report of gradualism is a Trump administration, or at least a cabinet of one, that's aware of the machinations of this market and wants to prevent the kind of ramp up in yields that we've seen, the pain in equity markets. If it is indeed policy that is a market put, how does that change the contours of the economic consequences? How does that change your evaluation and expectations of what we might get after the inauguration from a Trump administration?
Well, I think I would just say if the point of tariffs is to redirect global trade, you have to be willing to accept at least some short-term costs of that, right? So if you raise the cost of trade, you'll get less of it initially. Over time, your intended purpose is to rebalance where that activity takes place, maybe reshoring or onshoring. But there's a delay there, so you might have to accept some softness in the meantime. So I think gradualism reflects those trade-offs. They still want to move in a direction of redirecting global trade, but they don't want to do it in a way that, say, forcefully restricts the momentum that the economy has. So I think they're trying to balance those two components.
Michael, the rhetoric that we've heard from the Fed speak last week was about cautious, was about taking their time. If we look at the movement in yields relative to the rate cuts that we've had, since the jumbo rate cut in September, we're up 113 basis points. We've given back a couple this morning. The Fed has only cut by 100 basis points. We have a net constriction, as it were. When does that come to bear on the Fed in this pause period?
Well, at least if things proceed the way we would anticipate, I would say in the second half of this year, meaning in the near term, the rate market may remain under pressure as growth stays strong and uncertainty about forthcoming fiscal and trade and immigration policies is elevated. But as some of these get implemented, and our suspicion is you get more on tariffs and immigration and, say, less on fiscal, then somewhere in here, concerns about inflation or reignition of inflation, we think would give way to weaker or softer activity. We're not saying the economy is going to be truly weak, just softer activity. Then you're likely to see a rally in some of these longer-term rates. So very timing and policy intensity driven. It's hard to say, oh, in X weeks or X number of months, this is going to be a buy. But we think directionally, this will shift to an outlook where, the longer-term yields in the U.S., which have backed up, will likely move significantly lower.
There is another pressure that this country is only just starting to grapple with, Michael, and that is the impact of the LA wildfires. Along with the tragic loss of life, you have an area where many, many homes are being lost, and a part of the country that already has acute housing pressure. You have an economy, the state as a whole, that if you rank it by some measures is in the top 10 if it were a country. How are you starting to understand some of the wider economic impact of the devastation we're seeing?
Yeah, certainly it's harder to suggest that the wildfires create, say, significant macroeconomic effects in a $30 trillion economy. So granted, California is large, but we tend, from a macro perspective, the economist tends to look at this similar to how you might see a hurricane, some temporary disruptions that could affect the job market. We also find some evidence that core goods prices are a little higher after wildfires, but this tends to be more of a micro story where we've got insurers in play and we've got some of the municipalities at issue, but it's certainly something that we're watching. The devastation is hard to see and try and understand just from a pure analytical perspective. We should get some disruption out of this, but similar to, say, a hurricane, it's likely to be something that's say temporary or transitory and gets reversed over time. You could even argue it may help home building, but again, you don't want to go through the destruction we're seeing in order to make an argument to help home building. It's just obviously a devastating situation, and our thoughts are with the people of Los Angeles.
Of course, and we would agree with you on all those sentiments. Michael, really great to see you this morning. Thank you so much for joining us. Michael Gapin of Morgan Stanley. Let's get you some other top stories now that are trending on the terminal. And to the point of the wildfires, Southern California is facing another round of dangerous fire weather. Crews are struggling to contain the flames in Los Angeles that have killed at least 24 people. The U.S. Storm Prediction Center wind says that gusts are expected to be as high as 75 miles per hour. The blazes have scorched nearly 40,000 acres.
NVIDIA CEO Jensen Huang is embarking on a trip to China this week, visiting major cities. This as Beijing is investigating the company, and the U.S. is putting new curbs on AI chip exports. It's unclear if he'll be meeting with the Chinese officials during the trip, and NVIDIA has declined to comment.
The SEC has fined Blackstone, KKR, Apollo, and others over $63 million for failing to track employees' use of unauthorized communication platforms. It extends the agency's crackdown on those unauthorized apps for business. The firm admitted to violating record-keeping rules and agreed to improve compliance. Now, coming up, could Elon Musk be the next owner of TikTok US? Maybe this was the inevitable outcome. We're going to have more on that potential plan for the app coming up next.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's your Bloomberg Brief. Danny Berger and Manish Cranny in New York. President-elect Trump's team is busy at work with just 6 days to go until the inauguration. Sources tell Bloomberg that on tariffs, the economic team is considering a slow month-by-month ramp-up of 2 to 5% rather than starting big. For more, we are joined by Bloomberg's EMEA News Director, Roz Matheson. Roz, I think, again, this is an important part in this story to mention. Our Bloomberg reporting saying that the proposal is in its early stages and has not yet been presented to Trump. How would this square with what we know Trump wants from a tariff policy, and how likely does it seem?
Well, it's interesting to see this coming out, this Bloomberg report, as you say, that this is members of Trump's inner circle. It's got the fingerprints of the Treasury Secretary nominee Bessent on it, and the idea would be to be quite pragmatic in a way about the rollout of tariffs. So you start with one thing fairly small, you see how that results. Does it prompt a reaction? Does it prompt behavioral change? Do you then come back with something bigger and going up gradually? And a sense from that really in the market reaction today is that people are saying, well, this might signal some pragmatism in the administration, certainly in those who've got Trump's ear. The question, of course, as you say, is this seems to be something they're coming up with. They will then present it to Donald Trump. How will Donald Trump react? Does he want to come out of the gate either way with something very big bang? He likes to make a splash. Will he listen to this as a negotiating tool, really, on tariffs? It's hard to say. And he is someone who can change his mind, but he's been saying very publicly he's not really interested in gradual actions here out of the gate. So it's interesting to see at least the conversation that's going on in those around him. The question is, how would Donald Trump react?
Well, certainly we've got to wait to hear from the president-elect. We know that he likes to take to social media sometimes to quash ideas about tariffs. He's got his own very clear view about what he wants to deliver politically. He's got a number of his picks for cabinet up in front of Capitol Hill this week. Defense Secretary Pete Hegseth is probably the one that we're going to focus on first. One of his first picks at these confirmation hearings. Now, look, you've got a whole host of narrative here. You've got the Democratic leader, Chuck Schumer, saying it's about holding the feet to the fire. But Joni Ernst is going to be particularly important here as she's pivoted from being against Hegseth to perhaps being on his side.
Well, that's right. This is the Iowa Republican senator, and she's kind of arched an eyebrow at the very least over this nomination. But as you say, she's also kind of changed her tune a bit due to a public backlash over some of her comments. She's very interested, obviously, in the role of women in the military. And the reality is that even though the Democrats are obviously going to come hard in this confirmation hearing, you've got, allegations of sexual assault, public intoxication, financial mismanagement, all of which he denies. That's going to come out again in this conversation, and his credentials really to oversee such an important and significant organization in the U.S. administration. However, are any Republican senators going to publicly state their opposition, including the Iowa senator, given the makeup of the Senate and the GOP position there. At this point, it's unlikely. It's hard to see what's going to stop this nomination. I mean, all the lurid details in a way about him are already out there. So difficult to see how this confirmation would be stopped. And interesting also to see the others who are up this week, and really, again, people like the Treasury Secretary nominee. And it's in a way interesting to hear their views in these hearings, less about their credentials, but more about how they see things like the US economy, inflation, and so on.
Well, Elizabeth Warren's got 72 questions apparently from Mr. Hegseth, so he better be prepared. But no public dissent so far from the 53 to 47 majority that they've got. Ros, thank you very much. Ros Matheson there on the political trail. Time is running out for TikTok's US operation to find the alternative arrangement before the app gets banned. And Chinese officials, we understand, are exploring a potential sale of of TikTok US to the world's richest man, Elon Musk. That's according to Bloomberg sources. For more on the story, we're joined by Tamlin Basin, tech analyst over at Bloomberg Intelligence. So this is a pretty incredible story that if Elon Musk, who owns X, can get his hands on TikTok US, can you imagine the advertising and information sway that he would have? What do we know about the potential for the sale to Elon Musk?
Yeah, sure. So this is pretty fast-moving. It comes out of Bloomberg News reporting that the Chinese officials are the ones who are exploring a potential sale to Elon Musk. And I think it's key to note that we don't yet know whether ByteDance, TikTok's owner, is engaged in those discussions. But we know is that Chinese officials might consider this as a potential bargaining chip as they ramp up for how to deal with President Donald Trump in his second term with incoming tariffs. But what we don't know is how advanced these discussions are and whether it's going to be enough to sort of stave off the impending ban of TikTok, which would take effect on January 19th. So that'd be one day before President Trump takes over as president. So right now, we're sort of waiting to see how much substance there's the discussions, and is it going to be enough to sort of get a reprieve of that impending ban?
I mean, it just shows the immense power that Elon Musk has had since getting closer to President-elect Donald Trump. Tamlin, I think the point you make about China pushing this being a really interesting one, does it kind of suggest that ByteDance's fate when it comes to U.S. TikTok isn't in its hands anymore?
Yeah, well, I think if you actually look at why we're in this position overall, it is potentially because of China's influence over that app. That is because of all the sensitive user data that Chinese officials potentially had access to. So we always knew that China sort of had a hand in ByteDance and TikTok. So I do think it shows us that maybe if China was very invested in moving forward with a potential sale, that it might be able to get some things done. But I still do believe that ByteDance is going to have some say in this. And more importantly, I think it's also clear that we don't yet know whether or not this TikTok algorithm would be included in that potential sale. And that's something that Chinese officials have said over and over, that they don't want to see that sold. They see that as a piece of sort of national sense of security, that algorithm. So I think there's a lot of things that we're waiting to see further reported.
So many questions and literally 5 days to go into the ban. Tamlin, thank you so much for joining us. Tamlin Basin from Bloomberg Intelligence. We'll have more of your front pages coming up on your Bloomberg Brief.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice is my conversation, my poetry, you know.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent
Which
the
is a
Bitcoin
lot,
on beer and groceries and gas and video games.
And
I wish I had
hogs.
kept it. I wish I would buy a Harley today if I had.
Yeah, but you
that
probably wouldn't
Bitcoin.
be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
Let's get you some front page news. And major newspapers from the Times to the Post are all leading with the special counsel report this morning. It said that prosecutors believe that they had enough evidence to convict President-elect Trump had they not been forced to drop the case, Manus.
And let's take a look at what else is making the headlines. Standing with the Wall Street Journal. They lead with Israel and Hamas finalizing a ceasefire deal, citing Arab and Israeli officials. The deal could be announced as soon as today. Bloomberg had reported earlier that both President-elect Trump and President Biden said they are optimistic that a ceasefire deal would be reached within days.
And in the New York Times, we got some prelim data from the MTA showing that traffic is dropping after the $9 congestion pricing took effect in Manhattan. Manus, you got the stats.
We've got a few stats for you. You're all getting on the subway, not the tube, the subway. 3.8 million more riders recorded on Wednesday. That's up nearly 8%. And it takes you just 3 to 4 minutes to come through the Lincoln Tunnel as opposed to your average of 10 minutes. But it is New Year, and business is not as busy in the New Year.
You know what my very irrational fears is? I feel like we shouldn't talk about that there's less traffic, because then more people are going to come in because there's less traffic, and then the
Give
whole
me
thing is
$9.
nothing. Manus, I would give you all the $9 you want. Anything for you,
She's
Manus
generous to
Fanny.
me. Nancy Tanger, let's see what she's good for in just a moment.
To succeed in Wall Street, what skills do you need? You need to be somebody that claws people in the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative. At a time, nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger alongside Manus Cranny. Let's set your agenda.
A gradual approach. Incoming President Trump's economic team is said to be considering a slow ramp-up of tariffs. That Bloomberg scoop sends the dollar lower and snaps a 5-day rally and eases a global bond right. A backup plan for the TikTok ban is a potential sale to Elon Musk on the cards. More on the Bloomberg scoop in just a moment. Danny, good morning. I love that story.
If it rhymes, it must be true, Manus. I think them's the rules. Well, that trial balloon of a slow-rolling 2 to 5% increase in tariffs has arrested the downturn in equity markets, at least for now, led by what led the leg down. NASDAQ and Russell 2000 futures up more than 0.6%. Same goes for this bond market, which yesterday, before this story broke, before the close of bond markets, yields were at new multi-year highs. We are basically unchanged this morning, below 4.8%. But Manus, in looking at this story, and you made this really good point, this idea that this goes against what Trump wants, this idea of shock and awe, big tariffs. Why have this story come out? Why float this trial balloon? And I wonder if it is that, a trial balloon of the ability of Scott Bessent and other advisors to go to Trump and say, look at how the market has reacted to this. You're seeing an equity market rally. You're seeing a bond market rout ease. The market's like this. Therefore, perhaps a president-elect would like an approach like this, too.
It's got the hallmarks of the makings of a Trump put. You present it to the president-elect and say, look, these equity markets have wiped out the Trump bump. The bond markets, you can smell the rubber burning in the bond markets, quite literally, and there's a lot of concern that they're almost like a taper tantrum-esque. But this also, I think, gives us a little bit of an insight into the power play within Mar-a-Lago. Is it the cadence of Scott Bessent and that rationality about a bond market, perhaps versus Howard Lutnick, the Commerce Secretary? So it's the Treasury Secretary, perhaps versus the Commerce Secretary, but it's certainly different camps with different views on how to present and win the market's mind over tariffs.
Right, is it a preview of the Trump put? Is this what the next 4 years might be like on tariff policy? And Manus, it does come after you've had this switch in markets, because you had a tech-led market charging higher post-election. But then since this new year, you've had most major U.S. indices are down on the year. That's led by small caps. You can see they're down by 1.6%. Nancy Tangler, the CEO of Lawford Tangler Investments, writes, we may need a correction, but that doesn't always mean we get one. When we do, we think it is a buy-the-dip opportunity. Be patient and be deliberate. I'm pleased to say that Nancy joins us now. Nancy, what do you make of the weakness to start the year? Does this look like the start of that buy-the-dip correction that you've been writing about?
Well, Danny, thanks so much for having me. Good morning, Manus, and Happy New Year to both of you. Yeah, I do think so. And, you know, I was reading a piece by Ed Yardeni, and he said people accuse him of being a permabull. I am most definitely not a permabull, but I do think that we're in a bull market and that you use the volatility that's created by the hedge funds and the algorithms to buy the high quality companies you want to own. And, you know, we've been hearing the end to the technology story for 3 years. Every summer, somebody pounds the table and says it's over, we're broadening, and indeed, we really can't get where we need to go without technology continuing to drive earnings growth. And in fact, that is what we expect for 2025, as do most analysts, that technology will be the lion's share of earnings growth and margin growth, and to a lesser extent, revenue growth. So I do think you want to be patient. There was a lot of tax loss equivalent selling going on. You had people selling out of the bad names in the fourth quarter or in December. Then you're seeing them buy them back, and you're seeing them wait to sell the good names, many of the technology names. And I think that's really what we've seen for the first couple of weeks of the year. And I do think from here we'll start trading on fundamentals and earnings.
Well, Nancy, let's just square away. I mean, we sort of joke and jibe with you about NVIDIA, but NVIDIA dropped by over 13% at one juncture yesterday. The question is, when you see those kind of technical corrections, are you forced to reevaluate and buy a little bit of NVIDIA because you cannot live without it? You've got to take advantage of these moments.
You do, Manus. Absolutely. Like, if you just saw Jensen Huang's presentation at CES, I don't know how you could not be optimistic about the company's future and, in fact, the whole technology space. Now, you know, we own NVIDIA. We talked about it for a year. We got in the summer tech swoon, admittedly late, but we're still happy with where we entered. But the poor man's NVIDIA, Broadcom, is in our 12 best ideas portfolio, and in fact, one of my 5 for 25 names. And so I think the infrastructure spending will continue. We just heard Microsoft say they're going to spend $80 billion on data center build-outs in fiscal year 2025, which ends in June. And you've heard ServiceNow CEO Bill McDermott say he expects $20 trillion in AI spending by 2030. So you don't have to be, none of them have to be right. You just have to be directionally right to see a long future of spending in this space, and it will continue to drive productivity. And you know, productivity is kind of my thing. We've been talking about it for 2 years. We think productivity is what's going to save the day in the next couple of years.
Well, as these tech companies hope to grow, maybe through acquisition, maybe through building out these data centers, they're hoping that they're going to have a friendly administration as they do that. Nancy, perhaps that's partially what's behind kind of the magnification of some of these companies, of Zuckerberg going on Joe Rogan talking about masculine energy coming back, of him changing the look of Facebook, of Amazon buying the rights to Melania Trump documentary produced by her herself, Jensen Huang at CES himself saying he would love to meet with President Donald Trump. For you as an investor, how important is it, looking at these individual companies, these CEOs appealing to Trump? Is there any tradable information on that? I mean, at the very least, you got someone like Elon Musk, because of his closeness, potentially might end up owning U.S. TikTok.
That story is priceless. I love it. I hope it happens. It makes me laugh. But yeah, I mean, I think the pivoting by these CEOs is breathtaking. You know, I think Wizard of Oz, you know, how quickly people come and go here from Dorothy. I think that is what they do. And so, yeah, it tells you where they see the market going directionally. If you get just half of the corporate tax cuts that the president has telegraphed, or the president-elect has telegraphed, it will add 4% to S&P earnings growth. If you get deregulation, it's hard to quantify, but we know that that's also really a tax cut. So if you think about why these CEOs are pandering, you know, maybe they really believe it. I guess I don't want to be that cynical this early in the morning, but I think it tells you the direction and the animal spirits that will return. I've heard people talk about the Trump trade unwinding. It hasn't unwound. I think we'll continue to see it move forward. And this talk about, you know, staging tariffs. I mean, this is what this president-elect does. He throws out headlines, sees where they settle. He uses them as a negotiating tactic. But note that the tariffs actually against China, for example, were higher under the Biden administration than they were under Trump 1.0.
I like the way you sort of say, look, it's a technical unwind of the Trump bump in terms of a market that is retraced, but the fundamentals are there to carry forward. Can we just push a little bit further on the deregulation? You say you love the story TikTok X AI. I mean, it's a trifecta that would be a data man or woman's heaven. But it does speak to the regulation environment that we potentially go into for big tech in the next 4 years. And this is what Danny and I talked about this morning at the desk. And Danny said, you know, basically, yeah, if this will and could happen in a regulatory environment under Trump than in the previous 4 years, and that plays heavily to tech.
Yeah, it does, Manus. I think, you know, when Trump 1.0 happened, what you heard was that technology would be to the original Trump, if you will, what energy was to the Obama administration. But in fact, technology was the top performing sector during his presidency. And I think we're going to see that again. I think with Elon Musk in his ear and Vivek Ramaswamy, he understands, and I think he understands this himself, by the way, that we need technology to drive productivity. That is what makes America the best house on the global block. And we spend more on CapEx and R&D, and it shows up in our productivity and GDP numbers. And I think everyone wants to see that American exceptionalism continue. So I'm very optimistic that, you know, there'll be volatility, of course. We will ultimately get a correction at some point. But for your viewers, I think what they want to do is step back, take a breath, buy the great companies and add to your holdings. In my 5 for 25, for example, we added Spotify to our 12 best ideas portfolio. We've owned it for years. You know, sometimes you think, well, it's already up a lot, but that company's going to earn earnings growth is going to be 58% this year and 28% in 2026. So after the year of monetization, this strong management team has pivoted, and it's also a recession-proof kind of a stock. So I think there's plenty of those out there that investors can enjoy.
Indeed. I'm signed up to Spotify, and I heard you evangelizing about Amazon, but we've run out of time. Don't worry, we get that in there for the 5 for 25. Nancy, thank you very much for being with Danny and I this morning. Nancy Tengler there of Laffer Tengler Investments. Other stories trending on your Bloomberg terminal this morning. Southern California is facing another round of dangerous fire weather. Crews are struggling to contain the flames in Los Angeles that have killed at least 24 people. The U.S. Storm Prediction Center says wind gusts are expected to be as high as 75 miles per hour. The blazes have scorched nearly 40,000 acres.
The SEC has fined Blackstone, KKR, Apollo, and others over $63 million for failing to track employees' use of unauthorized communication platforms. This extends the agency's crackdown on the use of those said apps. The firm admitted to violating record-keeping rules and agreed to improve compliance.
And Volkswagen's deliveries slumped in 2024 as weakening EV demand and intense competition in China weighed on their sales. The German car maker delivered 2.3% fewer vehicles globally than a year earlier. Sales of fully electric vehicles fell by 3.4%. Coming up in the show, it's confirmation time. The hearings begin. We'll bring you the very latest on Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why does this business model work? Because it's virgin space. It's never been done before. And it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
This is Bloomberg Brief. I'm Manish Krenny alongside Danny Berger here in New York. We have less than a week to go until the incoming President Trump returns to the White House. Bloomberg has learned that his economic team is looking into a gradual approach to ramping up tariffs, increasing them by 2 to 5% a month. Joining us now is Bloomberg's Joshua Galou in Munich. So, Josh, this is one of those fantastic kites that is flying. This has all the hallmarks of Scott Bessent, which is about gradualism, rather than the shock and awe that we're used to under the first Trump presidency. How much of this would be sort of at odds with the President Trump-elect that we know, which is about shock and awe rather than gradualism?
That's a great question. It's really what's going to define his return to office, right? Because back during his first term, he would announce, I recall he announced tariffs during a cabinet meeting that no one had ever really prepared for. But it's a sign, Bessent comes in and he has a different style, as you say, than Trump. But, he's going to have to walk a line here. He's going to have to try and find a way for Trump to make good on his promises. He has pledged he's going to raise tariffs. But at the same time, not rattling markets. We've already seen long-term borrowing costs across the world go up in response. And the last thing that they need is to spike inflation, which is something that would be very high risk. People are already pricing that in.
I was going to say, because the existence of the story in itself is fascinating, because we've seen these kind of trial balloons been floated before, most recently from the Washington Post of only targeting for tariffs critical supplies coming into the U.S., which Trump quickly posted on Truth Social saying that it wasn't the case. To what degree should we view some of these stories as a trial balloon to say, hey, we can put these types of tariffs on to the extent that you want, but doing it slowly means, as you said, it doesn't upset the market?
Right, and I think that's fair, and it's important to understand that this report, about taking a gradual approach to the tariffs, this is something that even the people familiar with the matter have said is early stages. This is something that Bessent is working on with Kevin Hassett. It has not gone to the president yet, and that means, look, nothing's decided, but I think these are exactly that. These are they're sending signals to the market. Please don't overreact. Please don't already price in a 10 to 20% tariff. And I think it's also probably part of Bessent's strategy internally to try and show the president, walk him back a little bit from some of the more controversial policies that could have impacts that they don't want.
Josh, we're also starting the hearings of the cabinet on Capitol Hill. One of his picks there is the Defense Secretary, Pete Hegseth. The question you got to ask yourself, some of them are going to be more contentious than others. Some of them are going to be more interested in what their views on policy. But with Hegseth, how much of a journey, how much of a hill has he climbed in terms of pushback against his nomination, in terms of experience, and some of the accusations that have been made against him? Do you think that he's overcome the significant, pushback from the likes of Joni Ernst?
Yeah, exactly. That's the question, right? And I don't know that he's overcome that, but or if his efforts to overcome it, if that's the metric, or if it's about Republicans wanting to stay true to what Trump wants, and whether they're willing to really go and push back hard on a nominee. At this point, they have a 53 to 47 Senate majority. I just don't see it going as far as denying him the nomination. But of course, as you said, Joni Ernst, head of the Armed Services Committee, we'll have to see what she comes out with. She had early words for him where she was very critical of his record, the accusations of sexual assault, the mismanagement, and she got a pretty quick and fierce backlash from Trump supporters. So we'll have to see how tempered her questions are today. He's definitely going to face a lot of pushback from Democrats. But, to be honest, I think that the Republicans' willingness to actually go against Trump on a nominee right now, they'd have to take a pretty hard stand.
Potentially some must-watch TV today. Josh, thank you so much. Bloomberg's Josh Galou. Now, another Bloomberg scoop, and we should just say the Bloomberg news team has been on fire. Really impressive reporting today. The latest of which, TikTok owner ByteDance is evaluating potential options for the popular app's U.S. operations. Bloomberg sources say that one of the options for China is to have ByteDance sell it to Elon Musk. For more on this story, we are joined by Peter Elstrom, Bloomberg's executive editor for Global Tech. Peter, what do we know about the push? Again, we should emphasize this, of China having ByteDance sell rather than kind of a ByteDance-led type of sale to Elon Musk.
Yeah, that's right. So just a reminder, we're just days away from this ban on the TikTok app in the U.S. going into effect. That would happen on January 19th. The company has appealed to the Supreme Court. They'd like to be able to put a stay on that or maybe overturn it on free speech grounds. But in the meantime, what we've learned from our sources is that government officials in Beijing are debating a variety of options for TikTok. It's owned by the Chinese company ByteDance, and they're talking through options where they may do a number of things. Their preference is to win in court if they possibly can, to avoid a ban in the United States. But one of the backup options would be able to sell the TikTok U.S. operations to Elon Musk. Elon Musk is considered a close ally of Trump's, of course, and being able to pair the TikTok operations with X, the social media company that's under Musk's control, would have some appeal for them. It's not clear whether they've talked with the companies about this. It's not clear whether ByteDance or TikTok or even Musk himself have been directly involved in these talks. But government officials in Beijing are considering whether that would make sense. They have some control over the company because they have a so-called golden share in the company, and also because they have regulations in place where you can't sell that kind of asset with the algorithms that they have without government approval.
Well, Elon Musk has formed, he bought Twitter, and some people would say that he root and branch took that company apart. It's a fundamentally different organization. What kind of power would this give Musk? I mean, we don't know whether the TikTok algo will be included in any U.S. sale, but just the scale of kind of share of voice in the U.S. economy would Musk have?
Yeah, of course, it would mean more consolidation within the social media sphere in the United States would be a concern for certain people. And again, it's not clear whether they've talked through these things, whether Musk has any explicit plans, whether they'd be able to reach terms for a deal. It would be a huge deal, $40 to $50 billion, according to our estimates. But if you look at the precedent of Twitter, which is now called X, there are some pretty dramatic moves that Musk made with that company. He laid off 75 to 80% of their staff, figured he didn't need people doing a lot of things they had done in the past, including content moderation. Yeah. He agreed to just leave it up to community notes and let people take control of it. So he pared back a lot, he pared the staff substantially, and then he proceeded to kind of let the platform open. He calls himself a free speech absolutist and lets people talk about almost whatever they want.
Peter, yep, thank you very much. And we've just seen, obviously, Meta step back from some of its moderating here in the United States of America and moving to community nodes. So there's a sea change in tech. Peter, thank you very much. Peter Elstrom, the Bloomberg's executive editor. Some breaking news for you coming through on the potential for a ceasefire in the Middle East. This is from the Qataris. The Qataris are saying we are the closest that we've ever been to a truce on a deal. However, Qatar says that sides still disagree on some implementation details. This is after both the Trump and Biden administration have said that Israel-Hamas near a deal on a Gaza ceasefire. So we know that the Trump negotiators are there as well. We'll get you up to speed with that story in just a moment.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Some breaking news. Qatar saying that a truce between Israel and Hamas is the closest it has ever been. Let's go straight to our reporter, Mark Champion, on this. Mark, what do we know so far? How close does a ceasefire appear to be?
Well, it does seem to be as close as it's ever been. We have been here before, of course. It got quite close before, but the timing is very different. The fact that there's going to be a new president in the White House who's, both friendly to Israel and very insistent that there should be a deal by the time he takes office also seems to be really operative. The deal, as far as we know, isn't very different from what's been on the table before. And there still are some implementation details to get through, as Hamas and Qatar have both said at this point.
Okay, Mark, thank you so much. And of course, the president-elect's team is on the ground there as well. Steve Witkoff, that's the designated Middle East envoy. We'll track this story through the morning. Surveillance will pick it up in just a moment.
2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like this speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's going to be a volatile year, and there's going to be a lot of uncertainty there.
All of that policy change is out there for us to sort of take and accept, but I do think it's out there and it is positive in terms of where it's heading.
We don't see inflation accelerating from here like other people. Inflation is going to be demand-driven. I just don't see enough demand.
More towards the cautious side, not the optimistic side.
There are a lot of things out there that I think are going to be adding to volatility, but I don't think that we're headed for a deep correction or a new bear market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now as we come into Tuesday, looking for just a little bit more relief in the equity market and to build on yesterday's turnaround. Equity futures positive by, let's call it 0.5% on the S&P, up by close to 0.7 on the Nasdaq 100. The bigger gains are actually coming from abroad, in Europe, in China. On the Euro Stoxx 50, we advanced by about 1 full percentage point. Overnight in China, up by 2.6%. The why? Bit of dollar weakness in the mix. The why again? This story right here from Bloomberg. According to people familiar with the matter, key members of President-elect Donald Trump's incoming economic team discussing slowly ramping up tariffs month by month.
And Anne-Marie will tell you, we have been talking about this for so long, and she will talk about how we've talked directly about this with individuals that are coming into the Trump administration, and that this is actually just a proposal. It hasn't necessarily even been presented to Donald Trump, which raises the question, are we adequately pricing in just how much volatility there is going to be around the hearings this week, let alone the week after, and all of these different policies that are potentially going to whip around global markets?
I was in Palm Beach this weekend, and one thing that stood out to me is the foreign policy and potentially the trade approach of Donald Trump is going to be summed up in one word: unpredictable, on purpose. There's an element that Donald Trump wants in terms of keeping adversaries, and maybe sometimes some of their allies, on their toes. But what this story says to me is that Scott Bessent and his wing of the cabinet is winning out at this moment. It's the sausage making in real time.
So we've had 3 different versions of this story over the last 2 weeks or so. We had one from the Washington Post, another from CNN, and another from the team here at Bloomberg. And they all acknowledge that they haven't actually crossed the desk of the President-elect Donald Trump just yet. But I think this one is important. Scott Bessent said this on this program back in the summer. When he was in the running to become the Treasury Secretary, he talked about taking an approach which really lent towards negotiating with a partner. I think that is really important. Another important factor of this is the objective: to put a lid on the prospect of inflation increasing. That tells you they're sensitive about that as they're coming into power.
At a time where even J.D. Vance is talking about bond yields, I would add another element to this, and I think that that is very well said, and that is I wonder how much markets are actually going to be a check on the president. Is this not only a rehearsal for Scott Bessent and what he's going to be presenting to the president, but also a rehearsal of the market's reaction to competing proposals and how it will be taken in markets?
When Scott Bessent was an advisor, before he got tapped to become the incoming Treasury Secretary, he was a little bit more loose with his words, obviously, because he could be. And he talked about Trump. We pushed him on this idea of a tariff ring around the United States. He said that is an opening gambit. That is the maximalist approach. His idea was 2 to 5% every month. Xi Jinping, call us when it starts to bite.
Got a new question as well. Does Elon Musk get TikTok? Check this out from the team here at Bloomberg. Chinese officials evaluating a potential option that involves Elon Musk acquiring the US operations of TikTok if the company fails to fend off the controversial ban of the short video app. You're raising your eyebrows to this one. What did you make of that report?
Number one, does that mean that they're going to lower the price and basically sell it to Elon Musk as a fire sale, as basically a token of their goodwill because they also have a good relationship with Elon Musk, with Tesla in China? Is this essentially becoming a state negotiating tool, or is this actually about ownership of TikTok? And number two, is this the sort of concession that China is willing to sell it at all, which is sort of interesting ahead of where all teenagers are freaking out because TikTok is going to get banned on January 19th?
I think we can learn a lot from this story, and you brought up a good point. Is now this a point of leverage for the Chinese government to use with the Trump administration? And clearly they would choose someone like Elon Musk, who is the self-proclaimed first buddy, but also someone they know because of his work and dealings with China and Tesla. Can he do this deal alone? I talked to a source yesterday, and what I'm hearing is that there's lots of other people that are also interested in this. Does he team up with someone like Meta? And what kind of antitrust rules could potentially come into play, given the fact that they already own social media apps?
More on that story a little bit later. Equity futures right now on the S&P positive by 0.5%, bouncing back. We'll see if this move sticks. Joining us through the next 60 minutes, Stuart Kaiser of Citi, seeing rising bond yields as a positive for equities. Terry Haynes of Pangea Policy, as Trump's team considers a gradual approach to tariffs. And Matt Lazzetti of Deutsche Bank, calling for no rate cuts this year. We begin this hour with stocks rising and the dollar weakening, following a Bloomberg report that President-elect Donald Trump's team is considering a gradual ramp-up in tariffs aimed at boosting negotiating leverage and avoiding a spike in inflation. Joining us now, Stuart Kaiser of Citi. Stu, good morning to you, sir.
Good morning.
It's good to see you. What did you make of that report? How are you thinking about the trade approach from the incoming administration?
I mean, I don't want to call it best case, but that's what the market's hoping for, right? Is kind of a more rational, kind of gradual approach to this. I think one of the reasons markets have been a little weak to start the year is I think people are a little concerned about what next week's going to look like. What kind of headline risk do we face? And if you're getting things that seem a little bit more measured and balanced, I think that's probably a net positive for risk sentiment.
The source of the weakness has come from the bond market. You've been focusing on the why. You've said 1 million times that higher yields, I'll take that so long as it means it's underpinned by stronger growth. Is inflation a factor in this boost in yields that we've seen?
It's hard to kind of tease out, but if you look at the move in 10 years, let's say the 10 years up 40 basis points or so in the last month, real yields are 30 basis points, so that break-even's about 10. So that quick and dirty would say about a quarter of the move has come from the inflation side of the ledger. But I think if you were weighing the risks, more of the risk aspect, I think, has come from the inflation side of things. But yeah, I think from our perspective, as you know, I think a 5 handle on 10 years is better than a 3 handle on 10 years if you're an equity investor, because to get back down to that 3 level, you really need weak growth. So, definitely don't want to completely dismiss the risks of the speed of the move we've seen in the 10-year yield, but we do think it's coming from a more positive place than maybe the markets are giving it credit for.
Which raises a question: which are the areas that are most sensitive to higher rates? In other words, the other way to say this is, which are the least sensitive to it and can still continue to lead performance at a time when there are worries about longer-term borrowing costs and what this does to, say, small caps and mid caps and the like?
Look, I think there's a couple beneficiaries. One's banks, and people already love banks, so that's been rather convenient. I think other areas, people are probably a little more comfortable in a safer credit risk kind of equity. So your kind of larger cap stocks have benefited a little bit. Last week was really interesting because what you kind of saw is everything sold off, but like the equal weighted S&P outperformed the cap weighted S&P. So people kind of wanted to still be in large cap, but they also moved a little bit down the cap structure. I think what you're seeing there is a trade-off between I want to be in some more value stocks because value benefits from higher yields, but I don't want to go all the way down to that small cap stock quite yet. So people kind of moved a little bit down, they hit a fence and they stopped. And that fence seems to be around the top 500 US stocks. So what's benefiting is banks and its value mainly. And then, but I think that move has been limited by the fact that people are still a little bit concerned about what's going on in the background, and they kind of want to still stay a little bit higher in the quality spectrum if they can.
Some of the main drivers of growth have been big tech, right, for a number of years. And yesterday we saw an interesting development, an ongoing development over the past week, which is NVIDIA and Apple really selling off pretty significantly. There's some conflation here, that it's tied to yields. There's some conflation that it's maybe tied to policy. What's sort of the main driver? How do you view this at a time where a lot of people view that as the ongoing ballast of market performance?
And we would agree with that. I mean, I think if you look at earnings growth this year, S&P's at 15%, Mag 7's forecast to earnings more than 20%. So that's still kind of the core driver of your earnings growth story in the U.S. I think what you're seeing there and what you've seen for the last few quarters is going into the quarter, there tends to be, even within the Mag 7, a couple favorites and a couple kind of less favorites. And it could be that, you know, the product cycle on the Apple side maybe is not convincing people. NVIDIA, I mean, their leadership was basically in a headline war with the Biden administration last week. So, you know, there's clearly some policy risks that are going on there. So this is probably, in my view, those things that perform so well. You're going into an earnings season. You do have some policy risks on the sides, and that kind of maybe gives people a little bit of a trim up on risk ahead of earnings and the inauguration.
Stuart, you sound very constructive about growth, but the fact of the matter is, if we're in this moment of so much unpredictability and whipsawing sometimes of headlines that are pushing markets around, that in itself, can that hurt growth? Could it mean paralysis for some businesses?
I think it definitely could. And the flip side of that argument, if you want to come up with one, is if I'm worried about tariffs, I'm going to front load my inventory cycle and I'm going to get some stuff done now. But yes, I mean, obviously the policy uncertainty can kind of play into what CEOs are feeling and thinking, because if you believe the Trump positive growth impulse, a lot of that is just somewhat blind faith that he's going to be positive for the business community, right? He's going to deregulate. He's going to give us more clarity. He's going to allow businesses to kind of invest for the medium to long term. But I agree with you. I mean, a lot of PMs have told us, I'm going to run long the dollar. I'm going to run long risk up until about the inauguration, because I'm not exactly sure what next week is going to look like. And for that reason, I need to be a little bit careful on how I manage risk. So yeah, I think it can be.
So what do people do next week after January 20th?
I think a lot of it's going to have to do with the headlines. I think if you get a more gradualist approach on some of this stuff, going into earnings, people are going to be more comfortable having risk on. I think if you get a full bore, hardcore on the tariff side and very disruptive, then people are going to pull back on risk. And it's interesting next week, there's not a lot of specific event risk priced in for the inauguration. That's also a holiday, obviously. But the rest of the week is at a modest premium to the rest of the month, if that makes sense. So people are not sure when the news is going to come and what it's going to look like, but they're basically saying, okay, fine, from Tuesday to Friday, I need to add 8 or 10 basis points of implied move into the vol market because I'm just not sure how this is going to come out. And I agree with you. I mean, the uncertainty aspect and the effect on business is real. And I think actually we saw that during the Biden administration as well.
I think we all know we're going to get a string of executive orders at some point in the next week or so. We just don't know on what and how much of it we're going to get. Lisa, it's been a fascinating change, though. In early November, we all talked about this positive growth shock for financial markets that we needed to digest. Bond yields were higher. Equities were up alongside them. That correlation has just totally broken down coming into the new year. And if you looked at equities at one point yesterday, we completely wiped out the post-election Trump bump, just like that.
This is also, though, coming when the rise in yields isn't just completely, indisputably a positive thing coming on the heels of growth. Real yields, which is basically the yield term premium, have increased dramatically, particularly at the long end, which raises a question about deficit concerns and how much supply is as much of a part of that yield rise as growth is.
And unlike the Washington Post story that talked about tariffs, we have yet to see a truth or a tweet that this one is wrong. And I wonder if that is because Trump is recognizing that the markets don't like the tough talk on tariffs right now.
Give him a chance. And those tweets and those posts carry a little bit more weight from next week. Stuart, it's good to see you.
Thank you.
Stuart Kaiser of Citi there. Equities at the moment, as I say, positive by 0.5%. Busy week, kicks off a little bit later this morning. We will get PPI, then tomorrow morning we will get CPI, and then the bank earnings tomorrow morning. Tons of them on Wednesday, a few more on Thursday. With an update on stories elsewhere this morning, let's get to your Bloomberg brief and cross over to Danny Berger. Hey, Danny.
Hey, John. Southern California faces another round of dangerous fire weather. The U.S. Storm Prediction Prediction Center warned of wind gusts exceeding 50 miles per hour through tomorrow. The winds may limit opportunities for firefighters to make progress against the Palisades and Eaton fires from the ground and the air. The blazes have scorched nearly 40,000 acres and leveled entire neighborhoods from the Pacific Palisades on the coast to Altadena at the feet of the San Gabriel Mountains. Joe Biden and Donald Trump both say that they're optimistic about a ceasefire between Israel and Hamas. The leader said a deal could be agreed to within days, pausing the more than 15-month-old war in Gaza. Israeli officials said that they presented a detailed outline to Hamas during indirect talks in Doha. Sources say the first phase would involve a 42-day ceasefire and the release of 33 Israeli hostages in exchange for Palestinian prisoners. Starbucks rolling out a new code of conduct across its cafes across North America. The coffee chain is reversing a policy that allowed anyone to use its cafes, patios, and restrooms, regardless of whether they made a purchase. The company is also reintroducing ceramic mugs and expanding its free refill policy for non-rewards members. And that's your brief. John.
Danny, thank you. Appreciate it. More from Danny in 30 minutes' time. Up next on the program, the tariff agenda taking shape.
Tariffs cause a stronger dollar, so a weaker dollar with tariffs is it's an economic abnormality.
There would be income from the tariffs, so that's a big number.
That conversation up next, live from New York this morning. Good morning.
Influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Stocks positive here by 0.5% on the S&P 500. Bond yields contained for now. We'll see if this sticks. Your 10-year 478, your next stop later this morning. PPI data in America, the appetizer for the big one tomorrow morning. CPI just around the corner. At the surveillance this morning, the tariff agenda is very much taking shape. Here's the latest this morning. President-elect Donald Trump's economic team weighing a gradual approach to its tariff policy, ramping up the levies month by month to boost negotiating leverage and avoid a spike in inflation. Terry Haynes of Pangea Policy writing, markets likely are hit with downside reality as it becomes even clearer that tariffs won't be all one or the other. Neither all blustery overkill nor all gradualist bark with little bite, but a mix of the tactical and overblown focused and not. Terry joins us now for more after that very helpful quote. Terry, welcome to the program, sir. How much weight then do you put on our reporting this morning? The Trump team is putting this together. The president-elect himself hasn't looked over it. What do you think he'll actually decide on?
I think you've judged it, and your reporting has judged it appropriately. This is in the early stages. Trump hasn't signed off, et cetera, et cetera. As the quote you put up indicates, I've been on more on Team Gradual for quite some time, but. I think what will end up happening is that the blustery rhetoric will ramp up to, frankly, to obscure the relative gradualness of, there's another one, right? Relative gradualness coming in. And also I note that in your reporting that the word emergency is used, an economic emergency. And I've been telling markets for, I think, since before the election, but certainly in the last 2 months, to look for Trump using more aggressively emergency powers. And I think that'll discomfort markets some. They've been soft-pedaled by the previous administration. And Trump, for good or ill, is going to be much blunter about where we are geopolitically and economically.
Terry, when you look at our reporting, and you really coined the term the cabinet of rivals, would you say that Scott Bessent and Kevin Hassett are the ones that are winning out?
I certainly think they're doing everything they can to win out, including putting things in the press. The thing I would caution, though, is markets tend to make the same mistake over and over about Washington. The same mistake here is assuming the Treasury Secretary will go tackle the president and make sure that he doesn't do anything crazy. That's exactly where markets were 4 years ago with Janet Yellen. They thought that Yellen was going to be the centrist that took the progressive edges off what Biden had made deals with his progressive wing on, and that turned out very much not to be the case.
But Terry, if I could just interrupt you for a second, Janet Yellen is not Scott Bessent. Janet Yellen did not come in with a relationship that Scott Bessent has had for years with President-elect Trump. And at the end of the day, what we saw from Trump 1.0 is that he was regulated by the stock market. You would see some reports leaked, but then quickly changed because of the reaction of that leak report to the stock market. Do you still think potentially Trump 2.0 is going to be regulated by where the Dow Jones Industrial Average is trading at any day?
Oh, I think Trump will be very influenced by what the markets think about what he's trying to do. At the same time, I think what's going to end up happening is, markets always think that means they have the whip hand over Trump. I don't think that's the case, particularly as it goes to the geopolitics. And geopolitical concerns are going to play a much bigger role in this, in the economic views of this administration than they did the first time out.
In the meantime, people are looking to January 20th as the real event risk. That's what we were just hearing from Stuart Risk. And when I say people, I'm talking about people and markets. What kind of risk or sort of illumination do you think we're going to get this week with some of the hearings down in Washington, D.C. to confirm some of the potential nominees?
Well, I think people have been sitting in the markets, have been sitting around for over 2 months now wondering what it is that Trump's going to do, and they will certainly get some illumination over the next few days. I expect the Senate to question Secretary-designate Bessent very closely on exactly what the administration policy is going to be on day one and going forward, and talk about a lot of the linkages that you brought up in the Bessent clips coming into this segment, how he feels about strong versus weak dollar, how tariffs are going to play into that, and frankly, what his relationship with the president is going to be.
Do you think that that's really going to be the most seminal hearing, or do you think that potentially there are others, whether it's Pam Bondi or whether it's even OMB nominee Russell Voigt, who has some pretty radical proposals for how to adjust the budget in the United States?
I think Bessent by far is the most immediate impact on the markets, but I think that the OMB hearing will have a lot of impact as well, frankly, because one of the things, the big thing I see lurking out there for markets in the negative is what the Trump administration is going to do about fiscal debt and deficit and whether it can do anything. We're in a world right now where debt service is the biggest expenditure, where nobody's got the political will to do anything about fiscal debt and deficit. And you've got a lot of counter pressure building, not only ramping up defense spending, but the LA wildfires alone and the estimates of how much money that's going to take will play a major role in what tax cuts look like and what the fiscal fiscal policy looks like.
Terry, do any of Trump's picks not get through?
Yes.
Who?
I think I don't have one that is absolutely doesn't make it, but I think Hegseth has a very tough time. I think Gabbard has a very tough time. I think Bob Kennedy still has a tough time.
But wouldn't we know at this point, especially for someone like Pete Hegseth? I mean, his hearing is just in a few hours. Why go through with it if they didn't think that they have the votes?
Well, they don't know whether they do or not, frankly. So it's a little bit of a dice roll, but. The thing with Hegseth is that this will be an interesting test, Hegseth, of the seriousness of Trump defense policy. You put somebody in there who, as Hegseth says in his opening statement, apparently is a change agent more than anything else. That's fine, but the concern that comes from the Senate fundamentally is, well, change agents can't run bureaucracies, can't run the department, can't direct things in a particular way efficiently and effectively. So that's a lot of the problem with Hegseth, frankly, and what we're going to see with Hegseth really is a commitment to Trump defense policy and exactly what that is, frankly.
Hey, Terry, appreciate your time. Terry Haynes of Pangea Policy there on the latest down in Washington. There are going to be a couple of contentious hearings in the next several weeks, and that one in a few hours' time is going to be one of them.
It absolutely is going to be contentious when it comes to Pete Hegseth, and Axios has his statement in full, and he's talking about this idea of warrior and this idea of coming back into the Pentagon. When he speaks today, Pete Hegseth, I think you need to remember this was an individual who was on combat tours. So he'll be speaking to those men and women that are on the front lines.
It's also going to be interesting to see how much pushback Donald Trump gets from fellow Republicans. You talk about how everyone is a Joe Manchin, or at least the role that Joe Manchin played to Joe Biden. Everyone will be that, basically, to President-elect Donald Trump. It just raises this question. Is this market adequately pricing in the potential risks when you have the dual threats of basically upside surprise to inflation with some potential proposals and an expansion of the budget, or downside surprise with a more stringent use of tariffs and some other potential trade protocol? This is the reason why there's this jumpiness on any headline, and we've seen that this week.
I saw a ton of notes yesterday from fixed income strategists saying, don't try and fade this move in the bond market, don't touch it. I've heard a lot of people on this program talk about the prospect of high yields because of trade worries. Then Deutsche Bank came out yesterday and said break-evens are still not pricing tariff risk appropriately. So there are some people who believe that this run-up in yield so far has nothing to do with the risk around trade, because the risk around trade is not clear at all.
Yeah, the head of the IMF, Kristalina Georgieva, is talking about how this is even the threat of tariffs is causing this backup in yields. However, if you take a look at real yields, basically inflation stripped out, the idea of some term premium baked in, 30-year Treasury real yields have risen to the highest since 2008. This is something else that's driving that, and I think that has to be recognized.
Looking ahead to some very interesting hearings through the next couple of weeks. Watch out for Hegseth, fantastic broadcaster. The presentation's going to be very, very good here. The back and forth, that guy's sharp. It's going to be fast.
He's a professional.
Very much so.
At presenting. So it's going to be, I think it's going to be contentious, but he will come prepared.
One to watch a little bit later. One to watch up next on the program, Dan Ives of Wedbush on the chances that TikTok US could be sold to Elon Musk with China's blessing. We'll get into that in just a moment. Equity futures this morning, positive by 0.4% on the S&P. The dollar, just a little bit weaker. The euro, a little bit stronger. Euro dollar, 102.57.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Big turnaround in the stock market yesterday. Let's see if we get some positive follow-through. So far, so good. Equities up by 0.4 on the S&P, up by 0.5 on the Nasdaq 100. In the bond market, 2-year, 10-year, 30-year, shaping up as follows. Check out a 10-year maturity. Yields just about unchanged. 478.21. I mentioned some commentary coming from the South Side. Fixed income strategists yesterday saying don't touch this. Barclays, we believe it's a bit early to fade the long end sell-off. BMO, we won't attempt, Lisa, to fight the move.
At a certain point, how much are they conditioned by the past couple of weeks? Basically, anyone who's tried to fade this has gotten their face ripped off. It's been a very difficult one. I will say there is this difficulty of what's driving it, right? You pointed to this idea that Deutsche Bank pointed to, which was that basically it's not on rising inflation expectations necessarily, putting aside the University of Michigan sentiment survey. But if it's coming from growth, that's a positive. U.S. small business optimism just came out at the highest level going back to 2018. There are a lot of facets to this, some good, some bad.
Self-correcting, self-limiting, afraid we've heard on repeat over the past week or so. Goldman had this to say in the past week. We don't think the yield move has yet reached the point of becoming self-correcting. To your point on the economic data, where is it going to be self-limiting? In the markets? Have you seen enough damage to risk yet? In the economy, the data still looks pretty decent, soft and hard.
So it goes to this ultimate question, which is, are rates restrictive? And Matt Lazzetti, Bank of America, coming out and basically saying no. They're going to take a sabbatical this year because essentially this is not showing restrictiveness anywhere. And it goes to the idea of, are these rates sustainable? So don't buy this dip because this is the new reality and companies are doing just fine.
Matt Lazzetti of Deutsche Bank coming up a little bit later this morning. Look out for that. Just want to finish on foreign exchange. The dollar a bit weaker today. Euro stronger. Euro dollar was totally unchanged in yesterday's session. Euro dollar this morning, 102.59, positive by close to 0.1%. Under surveillance this morning, Southern California bracing for another round of dangerous winds as firefighters struggle to contain fires across the region. Winds exceeding 50 miles per hour are possible across Los Angeles and Ventura counties today into tomorrow.
It's really tragic, and people are looking at this. There is some insight into what potentially caused it, including some fireworks during the new year that never were fully put out, which is one of the potential consequences of very dry weather. Now the question is, how do you pay for it? How do you recover? And then the politics, which have gone back and forth and gotten pretty aggressive.
The politics will be one thing, but putting that aside, how much this is going to cost? A report last night coming out, new estimates from Wells Fargo and Goldman says that they significantly exceeding the prediction that already we had last week. I mean, we are talking about now as much as $30 billion. And this is before potentially these fresh winds and fresh fires. This can be a lot more expensive than even that.
The rebuild effort and the cost of it is going to be absolutely massive. This is not the only issue that we have to face. We've also got the hurricanes and the recovery in several states across the southeast that we were talking about only several months ago. They're still in a mess down there too.
So this goes to the point that Terry Haynes was talking about. At a time where you have additional costs that are going to be incurred with different natural disasters that are coming with increasing frequency, how do you do that? What kind of fiscal space do you have to do that if you're already contending with a deficit and higher benchmark yields?
Well, this is why Speaker McCarthy last week said to me, you have to come out of the gate and say, declare a disaster for California, put money towards there and also the border, and then do one reconciliation package. And he thinks that gives them a little bit more wiggle room and fiscal space to do so.
We'll focus on the rebuild effort a little bit later this morning. Wanted to bring you an update on the latest story moving markets. Bloomberg reporting that President-elect Donald Trump's team is considering a gradual ramp-up in tariffs aimed at boosting negotiating leverage and avoiding a spike in inflation. Sources saying one idea involves tariffs increasing by about 2 to 5% each month.
Not really surprised about this because Scott Bessent on this program, when he was an advisor to President-elect Trump months before the election, said this is how he using tariffs. This idea that you call Xi Jinping up and you say, we're going to put on tariffs every single month. It's going to add another 2, 3, 4, 5%. Let us know when they start to hurt and you're willing to come to the table and do a deal. What I think a lot of members of the incoming Trump administration will say to you is that Trump is not against trade, but he wants a realignment to make sure that the trade is fair. And right now, they do not think that China is playing by the rules.
How much is this basically different advisors petitioning the markets and figuring out, you know, look, I'm going to do an audition, see how this reads through into the market. And Trump, this is the response. So which do you want? And I wonder how much that's sort of an element here as well.
I don't know which advisors were behind the Washington Post story or the CNN story for that matter. I do think it's important that these are key economic advisors. This is Hassett, this is Bessent. They're going to be the key players in this administration. Whether the president listens to them or not is going to be the key factor in all of this. And that's why you're all sort of in this new world right now, the old world of Trump Volume 1. You have to wait to hear what the incoming president has to say on the issue himself.
Absolutely. He's going to be the final decision maker, but he will convene all of these people, as Terry Haynes have called them, a cabinet arrivals. You're going to have those that are a little bit more outspoken about tariffs. I'm thinking of Howard Lutnick.
Sure.
You're going to have those like Jameson Greer that thinks we need an absolute full decoupling from China. And then you're going to have others that want to take a little bit more of a nuanced approach like Scott Bessent and Kevin Hassett.
Lots to get through this morning, including this story as well. Chinese officials evaluating the potential sale of TikTok's US operations to Elon Musk. Sources telling Bloomberg that under one scenario being discussed, Musk's X would take control of TikTok US and run the businesses together. TikTok denied the report, calling it pure fiction.
Well, TikTok still wants to remain autonomous in the United States. They do not want to divest. What is so interesting is ByteDance even aware that Chinese officials are having this conversation and basically handpicking who they deem respectable in their minds to take on this company? Based off what I'm hearing, there are other people who are also interested in potentially buying TikTok. I would look to the likes of individuals like, well, Kevin O'Leary posted it on Twitter, but even other people like Peter Thiel. Where is he in all of this? Where is Mark Zuckerberg, who's made now a few trips to have dinner with the president-elect, and then went on Rogan and said, we need to make sure that U.S. data, U.S. tech stays in outside hands of governments, especially our adversaries. What I find so interesting is, one, why is the Chinese government handpicking who they want to control this company? And two, if it is sold, do they get the algorithm or do they need to develop their own?
We're a private company. There's no national security risk here. There's some separation between us and the Chinese government. Chinese officials turn around and say, this is who you could be sold to. What does that tell you about the situation?
That this is being used as a carrot in negotiations. And I think that that is a change in terms of what's national security, what end up as being a negotiating tool. That's one thing that people are going to be looking at.
Let's stick with TikTok. Dan Ives of Wedbush weighing in on the looming ban, writing the following. There is much more at stake here than just TikTok's fate, as the US-China high-tensions relationship are clearly at play, heading into a very important tariff discussion and negotiations for the Trump administration in the months ahead. Dan joins us now for more. Dan, welcome to the program, sir. Just want to start with your reaction to our reporting overnight. What do you think?
I think it makes a lot of sense. I mean, ultimately, it comes down to this 19th that's coming around in terms of January 19th. The Supreme Court ultimately upholds that ban. Behind the scenes, Trump administration working to sort of look at fixes. And I think when you look where Musk is in terms of just how close to Trump, they also trusted within China. This looks like a what could be a strategic road for ByteDance that they'd sell this without the algorithm.
So what does this mean about either national security or potential tit for tat? What's being used, a sort of conflation of public and private in a new way that, frankly, the business community has to reckon with?
Yeah, I mean, look, I think, Lisa, the issue here is the last thing that Trump administration wants is this come out day before inauguration. Because it does sort of set this off to a bad start in terms of negotiations with China on tariffs. That's why I think they're looking for ways, instead of just basically telling the DOJ not to enforce these actions when it comes to Google, Apple, and others. It would be a lot easier if the Supreme Court ultimately upholds the ban, that Musk, just given the ownership of X, given obviously the strong understanding of China and the relationship, within Beijing, this could be a first step. But it's going to be something we've talked about on the program. This strong alliance, the bromance between Trump and Musk, is going to have a lot of sort of twists and turns. This could be the first start.
It raises a lot of questions here also about antitrust and what's acceptable among social media tie-ups and what's not. Is this just a matter of who gets closest to Donald Trump is sort of okay to be able to make these types of tie-ups, and those who are not are basically on the outside and won't have access to any potential acquisitions?
Yeah, and look, you're seeing that there's sort of red carpet in Mar-a-Lago, right, from Zuckerberg to others. And I also think the important thing is Khan's done at the FTC. So I'm not necessarily saying it's going to be an M&A party here, but with her done at the FTC, that changes everything. And I think it just shows that they know ultimately they're going to need to make some deals. Everyone's trying to jockey for position. But when it comes to TikTok, I mean, this would be a golden asset. It would be sold without the algorithm. If it was sold without the algorithm and the hands are forced, 40 to 50 billion would be the price tag. Musk would probably get outside money. You talk about Thiel, where's Larry Ellison involved? Obviously a close friend of Musk, and obviously the relationship with Oracle. There's a lot of areas that this could take.
Dan, though, if TikTok is a national security concern, and we've heard that even from incoming officials that are going to be surrounding President Trump, like Congressman Mike Waltz, like soon-to-be Secretary of State Marco Rubio, then why would they bless a deal that the Chinese Communist Party is basically hand-picking?
Yeah, look, I mean, that's going to be some of the questions. The one thing I would say is, Trump, who obviously was for the ban, against the ban here, if it was under what you say, like an Oracle database and under some sort of, Musk ownership with oversight, it would have to be blessed, obviously within DC and the Beltway. But look, this is tricky. It's all a game of high stakes poker, but it all starts with TikTok. Supreme Court upholds that ban. They're going to look for ways behind the scenes. And I think that's why, Trump looks right to the right of him. It's Musk. And this could be a potentially viable option, even if it's a partnership.
Dan, we also see a number of TikTok users already going to some similar social media apps like TikTok. What's in it for Elon Musk to buy it, especially if the algorithm is not included?
Well, for Musk, if he got TikTok, it would be a game changer. The value of X would probably double off the, just off the start. So I think Musk recognizes this is something that would be just a rare, unique opportunity to get not just 170 million in terms of consumers, but what that could ultimately do from a content perspective if their hands forced in terms of ByteDance. And it comes down to, that's why they're going to say what they're going to say publicly. Behind the scenes, I think it's a totally different situation in terms of where this is all playing out.
Dan, can they afford it?
Well, they could afford it when they get outside investments. Musk would not do this solely, and that's why there'll be some consortium that would have to be approved. If we kind of took this step forward, that would have to be approved by DC, by, I think those that need to sort of check the box on a deal like this. And that's where when you look at Thiel, Ellison, others within that circle of Musk, clearly could be involved.
Where do you think it would leave Meta?
On the outside looking in, right? Zuckerberg, obviously he's already gone after Jobs. He's gone after Cook, and now you sort of look at Musk as sort of the next step here, right? So Musk and Zuckerberg are at the opposite sides. The problem is that Zuckerberg wants to get in on that inside, but Musk is really the one that has that, unique platform, but also he's the whisperer for Trump. And that's why there's only one person that would be approved by China. It would be Musk, given his strong relationship within Beijing. That's the important thing here. You guys all talked about it. This would be handpicked by Beijing. There's only one individual that they would handpick. It's Musk.
Dan, appreciate your time, sir. As always, enjoy Milan. Atalanta Juventus, I think, is tonight. Reach out to Steve Paliuca, owns the club. I'm sure he can get you some tickets. Appreciate it, Dan. It's good to see you. Dan Ives, thank you.
You're living vicariously through him?
I mean, I wanted to do that,
100%.
sure. Yeah, I mean, why not?
Yeah.
Why not? It's a few hours away from the city centre.
Yeah, I know. You've already looked into it. And
Get a
bought
car
tickets.
over. Anyway.
He's jealous
It
of you.
could have been a nice pre-Davos trip.
Can he afford it?
Well, what I find so concerning about this is that how is this going to acquiesce the concerns of individuals in Washington who are concerned about national security when China is saying this is the only guy we're willing to sell it with? That in itself should raise a tremendous amount of questions. And I know their FTC is going to be handing over the reins to Andrew Ferguson. Maybe a deregulatory approach, but not when it comes to big tech. That's not in the cards. And I think Lisa raised a very good point when it comes to antitrust issues.
Big story for us this morning and some fresh Bloomberg reporting on the subject driving things along. Equity futures this morning, positive as well by a few tenths of 1% with an update on stories elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, good morning, John. NVIDIA CEO Jensen Huang is visiting China this week. It follows the U.S.'s new limits on AI chip sales, which NVIDIA has criticized. China is also currently investigating the company's domestic presence. Huang's visit may involve meeting with Chinese officials, but his plans are unclear, and NVIDIA has declined to comment. NVIDIA CEO is expected to arrive around January 15th. Elon Musk will continue to have major access to Donald Trump when he takes office next week. The New York Times reporting that Musk is expected to use the office in the Eisenhower Executive Office building, which is adjacent to the White House. Musk is launching the Department of Government Efficiency, a task force which aims to slash government spending in the Trump administration. It's not clear whether Vivek Ramaswamy, Musk's partner in leading the project, would also have office space in the Eisenhower building. Greenland's prime minister reportedly says that he wants closer ties with the U.S., highlighting the Arctic island's push for independence. President-elect Donald Trump has been repeating his ambition to take control of the self-ruling territory of Denmark, which is home to 57,000 people. House Republicans have introduced a bill to begin negotiations called the Make Greenland Great Again Act. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next, paring back rate cut bets.
The Fed has got to get more strategic in its approach and has got to stop being excessively data dependent. When you're data dependent and you're just looking at the future through the lens of the past, you will get more and more confused as we go through these changes.
That conversation up next, live from New York City. You're watching Bloomberg TV.
About artificial intelligence. Is artificial intelligence going to enable you and others to say we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equities this morning, and good morning to you. Positive by a third of 1% on the S&P 500. The bond market settling down. Yields a little bit higher, but not even by a basis point. 478.42. Under Savannah's this morning, paring back rate cut bets.
The Fed has got to get more strategic in its approach and has got to stop being excessively data dependent. When you're data dependent and you're just looking at the future through the lens of the past, you will get more and more confused as we go through these changes. They've got to either take the approach of this is what we think the baseline is, or alternatively, we're not incorporating any new policies. The muddled middle causes all sorts of spillover effects.
So here's the latest this morning. Investors waiting for PPI out at 8:30 Eastern Time and CPI out tomorrow after recalibrating bets on a Fed's rate cut path. Matt Lazzetti of Deutsche Bank writing, the data supports our view that with growth sturdy, the labour market resilient and inflation sticky, there may be limited scope for the Fed to cut rates this year. Our baseline remains that the Fed will keep rates on hold into 2026. Matt joins us now for more. Matt, good morning. It's good to see you.
Good morning.
This is not a new call.
It is not.
This call a number of months ago, so I want to give you credit for that. What did you see at the time, and how are things playing out now?
Yeah, so we adopted that call back in November. It was after the election, and so I think expected policy changes were part of that. But I think if you looked at the economy in the back half of last year, and certainly what we've seen so far, growth has been strong. We're running growth at 2.5% to 3%, the consumer growing at 3%. We thought that the labor market was showing signs of stabilizing and bouncing back, and I think we certainly got further confirmation about that on Friday. And you had evidence that inflation was sticky. If you look at core PC inflation, it decelerated only very modestly by a tenth or two last year. Super core inflation was actually higher last year than it was the previous year. And so with inflation sticky, growth strong, labor market resilient, and policy changes that could be adding fiscal stimulus, tariff effects, immigration policy that could all be inflationary, we just didn't see scope for the Fed to be cutting rates this year.
Does that mean that you don't think that rates are restrictive where they are?
I think there's not much evidence that they are restrictive enough. So our baseline view is, the nominal neutral rate's around 3.75%. That's well above what the Fed has kind of benchmarked it at, though it's very close to what the market's pricing at the moment. And with that, I think the Fed needs to maintain some level of restriction. And so we have seen the labor market slow. I think that's been a good development from the Fed's perspective in terms of inflation. Governor Waller was really emphasizing that part of it. But when we look at other elements, consumer spending has not slowed at all. I think we'll get further evidence of that for retail sales this week. So I think it's restrictive. Is it restrictive enough to get inflation all the way down to 2%? That's still an open question.
Which is the reason why you have an increasing number of people not only taking a rate cut off the table, but also talking about the prospect of some sort of rate hike by the end of this year. Do you think that's feasible, or is that a step too far?
It's definitely not part of our baseline at the moment. We still expect that the next move is a rate cut, although we don't expect it until out into 2026. Is it possible? I think absolutely. What would you need to get there? I think you need that the concerns around the labor market fully dissipate for the Fed, so they can't be worried about upside risks to the unemployment rate. Could we get there in a few months with the unemployment rate coming down to 4%, job gains bouncing back? Certainly that looks a lot more plausible after Friday's jobs report. I think you also need to see inflation picking up to 3% or above. So accelerating, not just remaining sticky at these levels. The third thing would be inflation expectations. We have seen recent evidence of that picking up. University of Michigan showed this big uptick last Friday. The New York Fed's gauge actually picked up a little bit yesterday, so it's something to keep a watch on. But for the Fed, they first, I think, would use forward guidance, take out the rate cuts that they have in their dot plot, see what that did for financial conditions. We are seeing higher rates now tightening financial conditions a little bit. So the first thing for the Fed would be to guide towards rate being on hold before they contemplate rate hikes.
In your note about Trump 2.0, you talk about growth too fast, inflation too furious. What part of Trump's policies do you think are going to be the most inflationary, given the fact that the sausage making we're all witnessing in real time, and it's whipsawing based off report after another report?
Yeah, no, absolutely. I think it's important in thinking about the outlook. One is, what do we know about the economy prior to the policies? And there, it's kind of everything that I just outlined. Growth was stronger, labor market resilient to inflation, stickier. There's still lots of uncertainty about what tariff policies. We got some news or information overnight that it could be a more gradualist approach. When we think about our forecast, we did bake in tariffs. We have a 20 percentage point increase in tariffs on China. We have some increase in tariffs on European auto imports this year. And then we have a universal baseline tariff at a small amount next year. That is the most inflationary part of our forecast, but it only adds about 0.2 to inflation. Is there scope for that to be more, depending on if they come in more aggressively? I think absolutely.
What about Trump's immigration policies?
Absolutely has a chance to be inflationary as well. We do not have anything baked into our forecasts. From an immigration perspective, we essentially have immigration flows returning to where they were from a pre-COVID perspective. But when you look back at 2023, the biggest shock or surprise to the economy was this big influx of immigration flows and what that did to the labor force. We think that subtracted 25 to 50 basis points from core PCE inflation. So it was a meaningful disinflationary force. It was an important factor that brought the labor market into better balance without the unemployment rate moving higher. If you unwind that, it would be inflationary.
Do you think that supply side story distorted the Fed's view of how tight they actually were?
I think absolutely. I mean, we weren't building it in. We were not anticipating it. So we were not expecting that you'd see growth closer to 3%, but that happening importantly with disinflation in the background. That came as a big surprise, was the biggest surprise for the economy in 2023 and then into 2024.
That discussion is politically charged, Lisa, for obvious reasons, but ultimately it bailed out the Federal Reserve in a big way. In a big way.
And maybe it was one reason why, especially because some of that was undercounted, why the Federal Reserve underestimated the power. Maybe that the blip that we saw, the weakness last year, late last year in the labor market, maybe was the anomaly, not necessarily the beginning of a new trend.
Just quickly, I've got 20 seconds on the clock. Are you mentally adjusting that payrolls figure from Friday lower? Do you think that was the real deal?
So I think that there's definitely some seasonality on some of these things. Retail trade was very weak in November, stronger in December. I don't think that we're running at 250,000 jobs on month on average. But the key question for markets and the Fed is, are labor market trends strong enough that they're stable to potentially tightening a little bit here? And I think the answer is yes. Not that we're printing 250,000, but that we don't have to be as worried about the downside risks.
Matt, appreciate your time. Always good to see you. Matt Lazzetti of Deutsche Bank. That call made back in November is looking better and better. Data point to data point. We get another data point a little bit later this morning. PPI at 8:30 Eastern Time. At a second hour of Bloomberg Surveillance, your lineup looks like this. Emily Rowland of John Hancock. Libby Cantrell of PIMCO. We'll catch up with the Rheinmetall CEO, Armin Paprika, and the Villa Home CEO, Sean Roberts. From New York, this is Bloomberg.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent
Which
the
is a
Bitcoin
lot, by
on
the way.
beer and groceries and gas and video games.
And
I wish I had
hugs.
kept it. I wish. I would buy a Harley today if I had.
Yeah, but you
that
probably wouldn't
Bitcoin.
be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and a beer in my hand.
Don't miss the next Open Interest.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms. And he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
High-frequency data matters a lot, and it will be noisy in the coming months. It just looks like a very precarious stability, and we see that in survey data, anecdotes in the Fed's beige book, and so I don't really see that picture changing.
One way or the other, the Fed will get this under control. It just may take a little bit of tightening in between.
The rates market, the tightening of financial conditions, it's feeding back into equities, and it's causing risk off.
If the economy's strong, shouldn't that be good for earnings? And if so, maybe earnings start to, help stabilize things.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures looking better than they have looked over the past few days, up 1/3% on the S&P 500, on the Nasdaq 100, up around about 0.5%. The gains are bigger in Europe. They were bigger in China overnight. The Euro Stoxx 50 right now up by 1 full percentage point as we take out a little bit of heat from this dollar rally. Euro dollar positive on the session. We're up to about 102.54. The headline from the team here at Bloomberg: according to people familiar with the matter, key members of President-elect Donald Trump's incoming team discussing slowly ramping up tariffs, a gradual approach month by month.
Which, again, just points to how much, uncertainty there is about policy going forward, that this headline that hasn't necessarily been solidified, that is still a proposal, although from key advisors to President-elect Donald Trump, would have such a big impact on markets. But also, there's a larger question here, which is, again, what is the bigger risk? Is it downside risk to growth, or is it upside risk to growth? And is that what we're really seeing play into the bond market?
I think one key part of this report, though, is that it has not been presented yet to President-elect Donald Trump. It's just from one faction of his economic team. And it's those that we already knew their views well ahead of the election. Someone like Scott Bessent, who joined this program and talked about a gradual approach. Talked about when Trump talks about 60% tariffs on China or 10% tariff war around the United States, it's a maximalist approach for negotiating tactic. So this could be one way they go. But what we are seeing right now, and let's remember, he is a president-elect at the moment. What we are seeing right now is the sausage making in real time.
There is one key consistent theme, though, in all of this, the conversation Lisa's having and Anne-Marie's having: inflation risk. If you go through the body of the story and the reporting from the team here at Bloomberg, the objective here of taking a gradual approach is to avoid an inflationary spike. That's what this is about. The worry on Friday when you see a big payrolls report is about a re-acceleration in inflation. It's not about a re-acceleration in growth. It's about a re-acceleration in inflation alongside that and where it leaves this Federal Reserve.
And it highlights the difference between 2016, the last time Donald Trump was elected, and now. And basically the idea that inflation is at a much higher place just structurally than it was back then, at a time where there still is strength in the economy, which is going to tie the hands of a president who is a real estate owner. He wants rates lower, and yet will that be possible given the inflationary dynamics?
And raises questions about how constrained this administration will be by the bond market. We mentioned it a little bit earlier in the last hour or so. To hear the Vice President-elect, J.D. Vance, on American Broadcast News over the weekend, bringing up the bond market, not once, not twice, repeatedly, and doing so without even being prompted. That's where the focus is as they come into power.
Well, that's what I thought was so interesting about it. He wasn't prompted on the bond market at all. This was Shannon Bream on Fox News Sunday. She wasn't asking about the nuance of the bond market. He was talking about how bond yields are just too high. And then he talked about the fact that the net interest payments were more than our national defense, and they're on track to be that as well in 2025. And then Speaker McCarthy said to me, well, the market will decide. Well, if that's the case, then this reconciliation package, these tariffs, they need to make sure they have a handle on how much spending this is going to be.
How long before we coin MBAGA? Make bond auctions great again.
Wow, okay.
I think it's going to be a while for that one.
I'm going to stick my neck out and just say that's not going to catch on. All right?
MBAGA.
I don't think
I just think that could be really important because I think that's part of what's going on here.
All right, Bramo. Next off for this market, going to take some time to recover from that.
Please go ahead.
PPI at 8:30 Eastern Time, CPI tomorrow, and lots of bank earnings tomorrow too. JP Morgan, Citi, Wells Fargo, and Goldman Sachs. Coming up this hour, less of that, more of this. Emily Rowland of John Hancock as stocks look to build on yesterday's gains. Libby Cantrell of PIMCO as Trump's team considers a gradual approach to tariffs. And Sean Roberts of Villa Homes on the path to rebuild Los Angeles. We begin this hour with stocks pushing higher. Investors optimistic on a Bloomberg report that Donald Trump's economic team is considering a gradual approach on tariffs. Joining us now, Emily Rowland of John Hancock. Emily, good morning.
Morning.
We have been whipsawed from headline to headline, from data point to data point. Is this one any different?
I mean, it's just remarkable. And one of the things that we've been watching closely is the moves in the U.S. dollar. One of the things that we think has started to constrain equity markets so far this year is you've seen the significant strengthening in the U.S. dollar. You think about large cap equities, which were just carrying the crown of leadership last year. 40% of their revenues are derived from abroad. So that could be a significant issue for large cap stocks this year. So I think this morning you're seeing a bit of a modest pullback in the dollar, and that's probably helping risk assets a little bit.
Mike Wilson, Morgan Stanley, said rates drive beta, and what you're seeing in foreign exchange drives dispersion. Are you starting to see that beneath the surface on the S&P?
We're seeing a little bit of a broadening out in market leadership. Leadership is a tough word, I guess, right now, where we're seeing some pressure on markets. But what we typically see in these environments where bond yields are backing up, inflationary pressures or potential inflationary pressures, to your point, are building is things like value stocks start to do a bit better. Small caps get hurt. Of course, they have the highest levels of indebtedness, which can be an issue when the cost of capital is elevated. But I think value equities, in particular areas like energy, utilities, infrastructure-related assets, those are lower beta. They're more defensive businesses. They have dividends, and they have some element of inflation protection here that we think might be accretive to investors into this year if we see maybe another 2022 type playbook.
This is a confusing moment. This is confusing for all of us. It's hard to really understand where the lodestar is at a time where there's so many different narratives that go completely contrary to each other. I want to go back to 6 a.m. this morning when we got NFIB, small business optimism, which came in at the highest rate going back to 2018 at 105, really superseding expectations. Do you want to be more levered to a growth story or more levered to a conservative portfolio, one that is more protective and levered to maybe downside risk right now?
We would say a more conservative portfolio right now. What we're seeing right now is the biggest catch-up in history between soft data and hard data. So the hard data had been coming in well, things like the labor market. Of course, we added 250,000 new jobs last month. But when we look at the soft data, it had really been struggling, and then boom,
You get the results of the election and you have this massive amount of optimism and sentiment just pervading the markets. So we want to be mindful of here of watching this kind of mini bump in reacceleration and animal spirits and sort of in the way that business owners and people are feeling in general. Of course, there's a huge divergence between Republicans that are responding to those surveys and Democrats that are responding to those surveys. So we want to be mindful of that. We may be seeing a modest reacceleration in the economy, but the challenge is, and you guys have talked a lot about this on the show, is kind of the self-limiting dynamic of this backup in treasury yields that we're seeing on this potential reacceleration in growth. Borrowing costs are high. Mortgage rates are above 7%. Mortgage applications are plunging. Inventories are up. Housing is the economic cycle. And if we start to see the shelter component of CPI decelerating, that could speak volumes to the cross-asset dynamics.
But this story has been one that's consistent over the past couple of years, that it's been a frozen housing market, and that's only led to higher prices because everything else is doing okay, and there hasn't been enough supply. How much conviction do you have in this call of a slowdown to go headlong into longer-term treasuries at a time where other people are saying, you know, you might want to wait a little bit?
Well, it's not headlong, so we still haven't been overweight duration. We've just suggested that investors that are sitting at the short end of the curve leg into the intermediate part of the curve with a benchmark level of duration. And right now, the way the yield curve is sloped, we now have the potential for roll down as well, with the short end of the curve actually being significantly lower than the long end of the curve. I think what's notable about the housing market is you're seeing inventories up about 30% year over year, and a lot of that's concentrated in the hot spots. Like, remember when everybody left Manhattan during the pandemic or the West Coast, and they went to Austin and they went to Nashville? By the way, great cities. They went to Colorado. But what's happening now is Manhattan-based companies are saying, you have a job in New York, guess where you have to go? New York. So you're starting to see all that built-up inventory come back online in some of those areas as people migrate back to the major cities.
Emily, do you have a call on how high you think we could see the 10 years? People are debating whether or not we actually will hit and can sustain 5%.
Yeah, so 5% I think is about the area where you kind of see that self-limiting mechanism creep in. We're watching bond yields, of course, overseas, which you're going to see sort of an element of tracking there. And if all these overseas markets also have a harder time adjusting higher rates, you could see some downward pressure on treasury yields from there. But let's just do we want to do a little bond math? I know it's really early in the morning.
Go for
Lisa,
it.
do it. Even like, so think about, say yields went back up to 5.5%. You're still not seeing a negative return on the aggregate bond index because the yield is there. We're looking at yields that are above 5% on high quality bonds right now. You might have to get paid to wait on the duration front if yields sort of chop around from here. But think about what equity markets might do in an environment where we're at a 5.5% treasury yield. I don't think they would like it. So I think the fact that you're flat on bonds, you might want to take that.
I'm not sure what Lisa started, but Kevin Gordon of Schwab has written in and said it's Barbara. Bonds are really back and really awesome.
I love it.
I'm not sure that's catching on either.
More of this.
I got another message as well on the Bloomberg terminal. Turn her Bloomberg off and tell her to start her vacation now. When does this vacation begin?
Hey,
you know, time.
You really want me to go on vacation? I'll happily leave. Thank you so much. It's been really real.
Emily, appreciate your time. It's good to see you. Thank you for being here. Emily Ronan there of John Hancock. Equity futures this morning slightly positive with an update on stories elsewhere. Let's get to your Bloomberg brief and cross over to Danny Berger. Hey, Danny.
Hey, John. Los Angeles and the rest of Southern California are facing a second week of fierce winds as two major fires continue to burn across the city. Crews have been struggling to contain the fires, which have killed at least 24 people and scorched nearly 40,000 acres. The disaster is expected to be among the most costly in U.S. history, with estimated damages and losses between $250 billion and $275 billion. Special counsel Jack Smith said in a report that the Justice Department and that the president-elect could have been convicted for trying to overturn the 2020 presidential election. Smith's report details Trump's efforts to pressure Vice President Mike Pence to reject congressional certification of the election. It also highlights Trump's refusal to help stop the Jan 6 riot at the Capitol. Cleveland Cliffs and Nucor are looking at a joint offer for U.S. Steel. People familiar say the Cliffs CEO confirmed his interest in a media event and later told Bloomberg that he'd fund a deal using debt. A source says the partnership could include Cliffs acquiring most of U.S. Steel, while Nucor takes its mini mill assets. Shares of Cleveland Cliffs rising just by 0.5% on the news. And that's your brief. John.
Danny, appreciate it. More from Danny in about 30 minutes' time. Up next on the program, setting Donald Trump's tariffs in motion.
I think everyone is on board with a kind of forward guidance or a phased-in tariffs. If you bring down your tariffs, we will bring down ours.
That was back in August. We'll get to the latest up next from New York. This is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equity futures right now up by 0.2% on the S&P. Bond yields a little bit higher. Your 10-year 479.24. Under surveillance this morning, setting Donald Trump's tariffs in motion.
I have spoken to the president, spoken to his team, and I think everyone is on board with a kind of forward guidance or a phased-in tariffs. So, here's President Xi, here's 60%. It might be 2.5% a month for 24 months. Tell us when you've had enough. And at the end of the day, I think that Donald Trump views tariffs as a way not to, as an end to free trade. If you bring down your tariffs, we will bring down ours.
So that was back in August. Sound familiar? Here's the latest reporting. Bloomberg reporting President-elect Donald Trump's incoming economic team is considering a measured approach for implementing tariffs, gradually increasing the duties by fewer than 5% per month to ramp up negotiating pressure and sidestep inflationary impacts. With the latest, here's Tyler Kendall with more. Tyler, good morning to you. Is Scott Besson at the epicenter of this effort?
Yeah, good morning, John. Clearly, he's going to face those questions as we look ahead to his confirmation hearing on Thursday. But it is worth to mention again that those potential reasoning behind a gradual tariff approach could be twofold. One, to tamp down on concerns about any potential inflationary impacts, and two, to serve as negotiating leverage. I can tell you here in Washington, we actually had the Canadian ambassador to the U.S., Kirsten Hillman, on Balance of Power last night, who said that they are actively looking for ways to get to that negotiating table and that nothing would be off the table, except, of course, an acquisition of Canada, but clearly a bid to try to de-escalate tensions before they get here. And on the second point about any potential inflationary impacts, I actually caught up with one Republican strategist who told me, look, this is going to be way more palatable for congressional Republicans in particular, who will be questioning Scott Besson later this week, who have already expressed concerns about tariffs and in particular about rhetoric about any spike in prices and what that could mean to Republicans Republicans as they try to hold on to their slim majority in Congress going through for the next 2 years, and then again in the 2026 midterms, since they would like to see unified government for the total of 4 years under Trump's term. Just lastly, John, Bloomberg News, of course, reporting that President-elect Trump has not yet been presented with these plans. They're still very preliminary, but that they likely would be enacted under some sort of emergency power. We know that Scott Bessent would be needed for that.
Tyler Kendall, appreciate it. Tyler, down in Washington, D.C. Initially, these headlines were moving markets around, some dollar weakness. I can tell you just moments ago, euro-dollar turning negative briefly on the session, now totally unchanged at 102.45. Libby Cantrell of PIMCO is joining us around the table for more. Libby, good morning.
Good morning.
Good to see you. Let's talk about base case assumptions, underlying assumptions for you and the team at the moment. What are they? We've had reports from the Washington Post, from CNN, from us overnight. They're all considerations. The president hasn't signed off. What do you think will be when we end up?
I think in general, just in terms of the economic policy writ large, there are more questions than answers at this point. I think our view and what we're signaling to clients is that don't underestimate President Trump in terms of how deep-seated this ideology is. He's been talking about tariffs since the 1980s. He really is very focused on the goods trade deficit, which has increased with most countries, except for China, which it has declined, although China, of course, we continue to have the highest goods trade deficit with. So don't underestimate this, but I mean, he obviously, inflation was a huge issue for voters. And so he is going to be, it sounds like, potentially mindful, or his advisors, I should say. I think this is very interesting. This plan hasn't been presented to the president. And he is the ultimate economic advisor. He is his own economic advisor. So I think we should take all of these reports also with a grain of salt. But again, what we're telling our clients is let's not underestimate the deep-seated ideology that underpins some of these threats. And while we sort of say, while transaction man is going to be there, tariff man will also be very much present. And if there is forward guidance, if they do try to feather it in, maybe it doesn't spook markets, but we are preparing for increased tariffs. By and large.
He does like tariffs. I mean, over the course of the campaign, he called it the most beautiful word in the dictionary.